Hi, folks. We'll give it a minute to let everybody come into the webinar. Okay, we'll get started. Welcome back, everyone. We have 8 more investors that are going to be presenting about their strategy, their process, and also their favorite pick at the current price. And starting off the afternoon session is Artem Fokin. Artem, you can take it from here.
Awesome. Pleasure to be here with you. Thank you for the invitation, Ian. So let's dive in, and I hope everybody had a wonderful lunch. Okay, so by way of introduction, my name is Artem. I run Karakan Capital, which is an investment firm based in the Bay Area. Started about 7 years ago. I do not exclusively invest in microcaps. I have some large investments as well, but I do love investing in microcaps. And for those who are chess fans, Karakan obviously stands for a chess opening. For those of you who are not chess fans, obviously that's time to become ones, or at the very least, you can know where the name comes from. Disclaimer, this is not a solicitation or offer to buy or sell securities, and content below is for educational purposes only. So in terms of the strategy, the easiest way and the shortest way to describe it is I want to be hunting for multi-baggers. And then there are 3 questions. Why multi-baggers? Simply because I want to maximize return on time. It almost always takes as much time to analyze an opportunity with 200, 300, 500% upside potential as analyzing an opportunity that has 30 or 50% upside. So in that case, why bother? Focus on the big game. Second question, why primarily microcap and small cap? So when I was growing up outside of the US, I heard this quote from one of the American movies. When someone was asked why that person robs banks, he said, because this is where money is. So same with microcaps. In general, it's less efficient market. That's why I like spending time there. Little sell-side coverage, etc. And then the third question is, what's the research process for that? And this is where I work very hard to structure all elements to get to those multi-bag opportunities. It doesn't always succeed, but this is my attempt. So that's the research process, obviously oversimplified and overgeneralized in just 6 steps. So first, where do ideas come from? Honestly, from many, many, many places. Microcap Leadership Summit will be one of them. The most fruitful route for me, based on my experience, is simply meet with companies and with company day after day. And when you meet a few hundreds of them a year, at least some of them will be attractive. To be clear, most of those meetings end up being a waste of time, but few wouldn't, and some of them could generate very strong returns. And what I found in my experience is that very often the key ingredient to success is actually know that this microcap, this particular business, this particular opportunity exists, and find it out before the broad market does. The research process itself, again, oversimplistically includes 6 steps. First, what is customer value proposition? That's the key. Eventually, it's the customer who will determine the fate of the business. Second, what's the product, service, penetration, and potential market? What's the TAM? Third, what is competition today? And this is very important, how it would develop in the future. You never know, but you can develop different scenarios. Number 4, what are the unit economics of the product or service? In other words, how much money does the company make on every single transaction or every single customer interaction? 5th, what would financials look like 3 to 5 years out? And finally, what's the valuation is 3 or 5 years out? With that, let me share with you another exciting thing, which is my second disclaimer. I will be talking today about the stock of a company called GAN, G-A-N. This is not an investment recommendation to buy or sell GAN shares or related securities. This is an educational presentation, and Artem Fokin and or Karakan Capital LLC and or related entities have economic long position in GAN shares and or related securities. Okay, with that excitement behind us, now we're going into elevator pitch. So why I'm interested in GAN? So first, it's a business-to-business B2B SaaS player in an industry that is structurally attractive and also experiencing secular growth. By getting exposure to GAN, you also get exposed to secular trends of iGaming and ongoing legalization. GAN enjoys sticky customer base and high switching costs, structurally high margin profile, limited competition, beaten down stock today, found the CEO owns about 6%. Now, before we go any further, let me talk about my own biases so that you know the context. This is my actually second time being a GAN shareholder. I first bought GAN shares when it was an orphan stock listed on AIM in London. It was good days of second half 2016, first half 2017, and I paid less than $2 adjusting for splits. And it became a multi-bagger for me in 2020, 2021, so I really enjoyed the outcome and the research process along the way. I sold the shares subsequently, and I was quite sad to let the shares go. I miss being a GAN shareholder. And now, in my opinion, today, Mr. Market presents another attractive opportunity. Hence, I reestablished my position. However, maybe I'm just falling a victim of my own cognitive biases, trying to relive my glorious prior days from the past. Time will tell. Now, when you look at this graph, I think it has stunning beauty. First, the stock went up more than 1,000%, and now it goes down by more than 90%. Like, that's a beautiful chart. As you know, when you invest in microcaps, sometimes you invest in microcaps that were microcap, and now you're hoping it will become small cap or mid cap or something. Sometimes you invest in something that used to be huge, and now it's a microcap. Those I generally do not like. And here we have a situation where something used to be a microcap, stopped being a microcap, and now it's back again. I agree. Chart of the day. Okay. So how did it happen? How the stock goes first like this, and then it goes like that? Okay, so first, enthusiasm about iGaming in general has been fading. You can take a look at the stock price of DraftKings, for example, as a proxy for the space. You will see. Second, iGaming legalization wave has slowed down substantially. GAN growth has slowed down as well. Market participants extrapolated GAN's profitability from late 2019 into the future. And when that extrapolation turned out to be not the case, in other words, those market participants were incorrect, understandably, they ended up being quite disappointed. GAN also has added a B2C business, which is outside of the US, which made B2B revenue only 1/3 of total revenue. So most likely, a reasonable investor will conduct some of the parts valuation analysis, which is not rocket science, but it does make things more complicated. Capital structure at a glance, so that you know the context. Roughly 121 million market cap. There is some debt and debt equivalents, call it 28, cash and cash equivalents. So enterprise value of roughly 99 million. So true microcap again. Now, this is business at a glance. If you see too many boxes, don't worry, I'll walk through them very quickly. So GAN has two businesses, B2C and B2B. B2C is an interesting business. It's side of the US. It generates, it's profitable. However, I'm not going to focus on that one. I am more partially because I'm really excited about B2B opportunity. Second of all, Ian gave me only 20 minutes. Same for everybody. So that's why I need to skip something. That something will be B2C. And within B2B, they have PAM, which stands for Platform Account Management. Think about this way. If you're gonna spend money playing either iGaming or sports betting via an app on your phone, then something must be behind it to do everything behind. Call it back office of that business. Simplistically, it can be payment processing. It can be keeping track of your bets, whatever. So that's called PAM. Then there is sports betting engine that keeps managing bets. And then there is RGS, which is remote gaming server. Think about it as content. And PAM can be for iGaming and can be for online sports betting. Some of the selected B2B clients of GAN, Win Resorts, technically it's Win Interactive, which is a digital arm of Win. For example, they work with GAN. FanDuel is another notable client. Now, if you look at revenue model, how does GAN make money? So in my opinion, it's a beautiful revenue model. It's based on take rate. Normally, GAN takes certain percent of whatever revenue. It can be net revenue, can be GGR, which is gross revenue, obviously depends on the contract. I believe net is more common. whatever the customer makes, GAN will take a percent. So it aligns GAN well with the success of their customers. It's also because it's effectively usage-based, it also makes net revenue expansion a little bit easier, in my opinion. Because if you go like one way you can expand your revenue, you need to increase prices. That's tough to do. On the other hand, if your customer simply makes more money, and now that customer writes a bigger check, it's a little bit easier. Geographic footprint, as I said, GAN B2B business is mostly in the United States, mostly. B2C business is mostly outside of the US. And this is important, and there is this misconception, I believe, in the market, that GAN, some people say like, oh, GAN is competing with its customers. It's almost never the case. There is one or two exceptions, but it's almost never the case. So we don't have this conflict of interest here. So product offering, GAN can provide one-stop shopping or a la carte offering. Remember those few boxes which I showed? You can pick all of them or one of them. PAM for gaming, PAM for online sports betting, GAN Sports, which is again mentioned that sports engine. It used to be formerly called CoolBet, and GAN acquired that and renamed it as GAN Sports. And then there is Super RGS. Why having multiple products is important? A couple of reasons. So first, it allows you to increase and maximize the wallet share. In other words, if your customers are going to spend $10 out of every, I'm making these numbers up a little bit, out of every $100 they make, don't let them spend money with other vendors. Try to capture as much as you can. And then it also allows you better leverage sales and marketing costs. Plus, some clients come to iGaming, online sports betting, by choosing PAM first, and then they pick up sports betting engine. Some people do it in reverse order. So having multiple products allows GAN to meet their customers or potential customers wherever they are in their customer journey. Customer value prop. Gaming is moving online. That's a big picture idea. Legacy operators, think about brick and mortar casino that has very loyal customer base in its locality, wants to enter online world. Yet those brick and mortar players are not tech companies. It's tough for them. They don't have expertise. They don't have resources. GAN can do that for those customers. It can do a little bit of hand-holding and bring them online. Only a few largest iGaming players have scale that allows them to bring the tech in-house. For example, DraftKings has that tech stack in-house completely. GAN is licensed in most jurisdictions in the United States where gaming or online sports betting is allowed. And speed to market. If iGaming operator chooses a wrong PAM or try to do it itself and misses the launch of the entire state, well, good luck catching up with other competitors who already captured the market share. And finally, there is an interesting patent that GAN owns, which links offline loyalty reward system with the online world. In fact, there is an interesting litigation being pursued right now by GAN against one of the companies in the brick and mortar space. We don't know the outcome, but it's very interesting to watch. And by the way, this patent litigation and potential patent monetization in the future, I'm not even counting on that at all, but it can be a very nice uplift to the entire free cash flow / revenue of the business in the future, if they win. So GAN is building a moat as we speak, in my opinion. It has high switching costs. There is anecdotal, I wouldn't call it data, but people's view that if an existing operator tries to switch from one PAM to another PAM, you can lose anywhere between 25 up to 40 or even higher % of your clients. So it's probably risky to do that, to say the least. Then GAN has track record. It's launched in many states in the US, launched a number of operators, and those operators are making money. GAN also knows regulations and has very collaborative relationships with regulators. That's important. Reputation. Nobody gets fired for buying IBM. If several good players launched using GAN in Michigan or New Jersey or Pennsylvania or any other place, and it's working, you're probably not going to get fired if you go with GAN in a new state when and if such state legalizes. And then there are also, as I mentioned, integration across several products. And by the way, it should be spelled with 2S. Now let's look at GAN revenue. The black color is B2B and green color is B2C. As you can see, 2018, 2019, that was a big jump in revenue. From 19 to 20, it was less expensive. Remember, from year to year, revenue can be jumpy because in addition to recurrent revenue or usage-based revenue, there may be some additional one-off sources of revenue, which is really implementation revenue. So it comes and goes. It's still, I would think that GAN still makes money on that, but it's not the area that is recurring. So it's less exciting. So you will see some variability from year to year. And if you look at 2021, 2022, you also will see green boxes or green bars. This is B2C revenue. And you will see that it's a lot bigger than B2B. And that's what I think also creates some confusion among investors. This is GAN gross profit margin. So from 2019 up to second quarter 2020, it expanded nicely. And as you can see, it's hanging around 70%. So it's pretty good gross profit margin. This is adjusted EBITDA. It's either annual or for 2022, it's LTM as of June 30th. And this is what is interesting. You see, it has been a little bit all over the place. You've seen some very negative years. You see some very positive years. And I will zoom in a little bit, and I will show you here EBITDA margin quarterly. And you will see that at some point, GAN did 50% in fourth quarter 2019. And that's what got people really excited. And when later the EBITDA margin didn't show up, I guess many people were disappointed. This is GAN valuation at a glance. Again, you can pick any multiple, any metric here that you like. It can be gross profit, but that includes, remember, B2B and B2C. Or you can look only at the recurring revenue, which is B2B recurring revenue. It's a third metric from the top. That's roughly 2.5 times. So again, I think for this type of business, it's way too cheap. And remember, I'm also ignoring any B2C here. Now, what are the risks? First, gaming industry, iGaming structure. If you believe that top 2-3 players, whoever those will be, would eventually control 80% plus of the US market, GAN may be in a tough spot. Because in order to be successful, in my opinion, GAN needs to have different players in the market. And some of them will be having tech in-house, for example, like DraftKings does, and some will be using either GAN or someone else. So that's one risk, something to watch out for. Then competition. Right now, competition is limited, but it's something to watch out for continuously. Now, how I think it should play out, and again, I'm saying should in quotes because who knows? But this is my timeline, how I think about it. GAN would continue to grow its B2B revenue. I think the margin should be expanding, and GAN should get to FCF break-even probably in 2023. Continue expanding margins even after that due to very high incremental margins. I estimate incremental margins to be between 40 and 50%. As revenue grows and margins show up and expand and free cash flow hits, I think the multiple would increase accordingly. Nice bonus, if in any new states in the US or maybe even countries may legalize, that would be great for GAN. For example, when Ontario in Canada legalized several months ago, one of the big GAN clients launched there and GAN is supporting them. That was a wonderful gift from our neighbors across the border. Finally, B2C. I haven't even spoken about B2C business, but it's still there. It's profitable. It does something good. And on top of that, remember I mentioned that patent litigation, that can be a very nice wild card in a positive way, in my opinion. So what's the upside? Look, I've shown you the multiple way trades today. I think the B2B revenue should be growing. I think multiples will be expanding. Hard to guess. I have my views, but I'm not going to try to be, I'm not going to share with you what I think multiples should be at, because it's always a little bit of a beauty competition. I think 2.5 times recurring revenue is way too cheap. Should it be higher? I think so. Can it be 5? Probably. Can it be 6? Maybe. 7? It's also possible. And remember that the revenue stream, that is, in my opinion, will be increasing. So that's my contact info. If you have questions about GAN, feel free to reach out. And I think we have about 1 minute for questions.
Thanks, Artem, for the presentation. Yeah, we have a couple questions that came in, if we can get to them quickly. And you kind of mentioned the first one in your risks. The questioner said, the bear thesis is that 80% of the iGaming market is run on the internal platforms of the largest B2C operators like FanDuel that leaves GAN to compete in the remaining 20% of the market for the smaller bricks and mortar operators. What are your thoughts on this?
Yes. Okay. So number one, in the several points. So first of all, FanDuel, as far as I know, uses GAN for some of their products, not for all of their products. That's number one. And FanDuel obviously is one of the biggest players in the market. So to me, the fact that a giant, successful giant with a lot of resources uses GAN tells me that it's really, really, really difficult to do it yourself. That's number one. Number two, could it happen in the future? Yeah, it's possible. It's a risk. So that's why it's important to watch every state. And that's why, for example, WIN, we want them to be successful. MGM, we want them to be successful. Some local tribal casinos in different states in the United States, we want them to be successful. If you look at other countries, it's incredibly rare that 2 or 3 players have 80% of the market. It's incredibly rare. Can US be an exception? It's possible. It's not a bet that I'm making. I don't think it will happen, but it's a risk and it's something to monitor.
Thank you. I think that bumps us up against the time constraint. Thank you, Artem. If anybody has any questions, Artem has his contact information up on the screen. And thanks for participating.
Thank you, Ian. See you next year.
Thank you. Okay, I believe Harris, you're next. There you are.
Hey, let's hope this works. Ian, you want me to get going?
Yeah, you can get going.
Great. Well, I'm happy to be here. I'm not exactly a microcap investor, but honored you asked me to give it a try. I want to talk about inflection investing. What is inflection investing? I guess I'm glad you asked. It's gonna be a monologue. Sorry, it's interactive. But first, before we get into the inflection investing, let's get a quick word from my lawyer. We spent quite a lot of money on this disclaimer, so I hope at least someone ends up reading it. Quickly about me, I work at Presentación Capital. I run a hedge fund. We're about 180 million of AUM. Typical long short, though I mostly stay on the long side, focused on using macro trends and inflection investing. You can get more of my writings at adventuresinCapitalism.com, and I run a data subscription product named Kedem, which we'll talk about briefly.
Hey, Harris.
Also,
Harris,
yes?
are you sharing a presentation right now?
Yes, do you see it?
No, I don't.
Oh, that's annoying.
Yeah, no worries. Just see if you can bring it up.
Got it. Here we go. Share screen, share. Now do you see it?
Yeah, and I'm just bringing in the slideshow mode. You should be good to go. There you go.
Sorry. So
No
anyway,
worries.
here's my very expensive legal disclaimer. Just about us. Like I said, we run a hedge fund, Presentación Capital, 180 million. Come find me at Adventures in Capitalism. Sign up there, and I also have Kedem, which we'll talk about briefly. What we're doing seems to be working. Inflection investing isn't just a theory; it produces returns. And if you gave me $1 back when we started the fund in 2019, it's worth about $7 today net of fees. So very proud of how it's all going. And as our CCO likes to say, it's definitely not indicative of future results, though I feel pretty good about the future. What makes my fund different? I like to think of myself as an old school hedge fund manager. It's going to be volatile. It's going to be, contrarian. It's going to hopefully produce way better numbers than most other funds. Basically focus on being flexible, concentrated, absolute returns. We do a bit of event driven, and it's just a different sort of fund than what you see out there amongst a lot of funds. Inflection investing itself. Look, there's a lot of cheap stocks out there. Cheap is cheap. It is what it is. But the vast majority of cheap stocks stay cheap. The whole point is you want to wait for an inflection, then catch that inflection. And I feel like a lot of investors just buy a cheap stock and hope someone notices it. And I'm really showing up when the situation is getting better. And basically the intersection of value and a catalyst is where the alpha comes from. Quickly, a shameless plug for Kedem. You should all go take a 4-week free trial. Go to kedm.com. What is CADM? We're tracking about 25 corporate events and special situations. Inflections often come from corporate events, restructurings, spin-offs, bankruptcy exits, CEO change, privatization, activist campaigns. There's all sorts of things that unlock value and take a business that's really been suffering for a long time and set it on a new direction. And I don't know, I found CADM has helped me flag a surprising number of special situations that really unlocked value. So I just want to talk quickly about where the hedge fund industry is right now, because when you think back to the 1970s, the Bruce Kovners of the world, those guys really made money. And today, hedge funds are mostly underperforming, which is kind of sad, really, when you think about it. And the question is just, where the hell did the alpha go? I think this, montage of nonsense is part of the problem. Everyone got themselves into a funny style box. They marketed it to allocators, and they can't get themselves out of the box. And the world changes quite rapidly. And to everyone who's self-styled as a microcap investor, I know it's kind of heresy, but don't just restrict yourself to microcap. There's a whole world everywhere. And I find way too many portfolio managers have sold themselves as being X and they can't do Y or Z. Otherwise, it's style creep. And the net result is they're just going to be structurally underperforming. And, I think the other problem is that a lot of people really are fixated on low volatility. If you think of the hedge fund world, I mean, a lot of these guys show up and they say they want to do 50 bips a month and then put, a turn of leverage on it. And the net result is they always blow up on every volatility event. And, I feel like the world of allocators focused on low volatility is just because guys have marketed them a product that's low volatility. And so, don't be scared of volatility. Volatility is good. I mean, upside volatility is better, but volatility is part of the game. And finally, I tend to think that the vast majority of hedge funds really run marketing businesses, and they happen to own some QSIPs. It's kind of sad to see all these multi-billion-dollar hedge funds that effectively own Apple and Google, like my mom. I mean, who needs 2 and 20 for that? But anyway, I kind of want to throw that out there just because I feel like our industry is all screwed up right now. But let's talk about inflections, because this actually works. The vast majority of securities are more or less appropriately valued. You take a drag and drop on Google or Apple or whatever. I mean, these computers can arb it all away and figure out what the right discount rate is. I mean, the opportunities come around corners, stuff that computers can't see. I like to talk about this situation. I call it the dead has risen, but it's a security that's just been underperforming for a very long period of time, not a couple quarters. I'm talking about a decade, maybe 2 decades. There's extreme yuck factor. When you tell your friends about it, I mean, they just look at you funny. When you tell your clients about it, you get fired. It's been kicked out of all the ETFs and indexes. So, a lot of the float is just, kind of ownerless. Portfolio managers can't own it. Like I said, the clients will laugh at them. And then some macro or corporate event, on one side, you have something like CADM, which will flag the corporate side. But on the other side, if you're dumpster diving, you'll eventually find macro events. I mean, if you take one thing away from this presentation, it's that the biggest upside comes when a situation goes from completely fucked to sort of shitty. And I just want to say that again, completely fucked to sort of shitty. That's where alpha comes from. Just kind of going back in time 2 years ago, remember the yuck factor? All these funds had to dump all their carbon. And I mean, think about it now. The best performing sector is carbon. I think we're in the second innings of this. Fortunes are going to be made in energy. And everyone pitching the ESG stuff to their clients is kind of a grifter. So anyway, that's kind of like enough about me. I kind of wanted to throw these things out and kind of set the stage for, the stock I want to talk about. And I want to talk about Lee Enterprises, because I think this is really fitting into the theme of something that's been totally left for dead, just forgotten by time, where things are really working. I mean, quick background, 115 million market cap, assuming it's at $19 a share, about 600 million EV. It's got tons of debt. It's less than 1 time EV to sales. There's a lot of upside leverage. And I think there's a really clear path to them getting to in excess of 150 million in annual EBITDA with less than 10 million in maintenance capex. And I think it's like 2, maybe 3 years into the future. And the main point I want to make is that increasingly large percentage of the EBITDA is driven by digital revenue. I mean, everyone likes to think of Lee Enterprises as a slowly melting ice cube of newspaper. And they don't notice what's happening on the digital side. So let's talk about digital here. Digital revenue on the left, it's accelerating rapidly. I think it's going to keep growing. Digital subscribers is also growing very rapidly. They're way ahead of their targets they give for 2025 on both categories. It's just rapid growth. You have to think back a bit. Most newspapers were run by journalists. They were horribly mismanaged. They literally charged people like my dad for the print version, and they gave the product away for free if you went to the website. The website was hard to navigate. It was a clunky, boring, bad product, and with minimal innovation. I mean, it's just crazy to think that in this day and age, there's still a factory that they chop down trees, they feed newsprint in, they print it, and then a bunch of guys deliver it to your house in the morning. It's insane to think about. And it's a reason that newspapers has always been a nice recurring revenue business, but a small margin business. As you go digital, some of the revenue peels off because you're not chopping down trees anymore, but your margins explode. And I don't think people have really realized that. And over the last few years, after the New York Times showed people how digital works, companies like Lee Enterprises have copied. They've built apps for your iPhone. They've made the product much better. And it's a sticky product. People want to know what's happening around them as long as the price is reasonable. And at about $10 a month, I think is very reasonable. Let's look at how the inflection's working, though. Year over year growth, it's just there in the 50-60 range consistently on the digital side. I want to show you this chart on the right. This is print versus digital. This is advertising. And whereas a subscriber won't cross for a very long time, just because, think of the cost of a print newspaper versus digital. But on the advertising side, they've already crossed. Q2 and Q3 are the first 2 quarters where the two crossed. And print is still declining, digital is growing. I like these sort of situations where you have like an X and a Y axis and they cross, and suddenly revenue is no longer declining, revenue's stabilizing, and then it starts growing. And once revenue stops declining, EBITDA is growing. Once revenue stops declining, people start looking at it and say, hey, this business isn't melting, this business is growing. And I want to show you, perfect comp what I talked about in New York Times, but you can see where digital and print kind of crossed. And you can see what the stock price did. And, it was a nice trade. And I think this is a very good comp for what's about to happen with Lee Enterprises, except for it's got, a bit more financial leverage, a bit more operating leverage, and it's substantially cheaper in valuation in terms of multiple on revenue. But let's play it forward 5 years. What is Lee Enterprises worth? You have a rapidly, you have a digitally native business that's rapidly growing. In 5 years, I think most of the print will have been churned off and it'll just be a digital business. They're in the process of shutting down print plants all over the place and just forcing subscribers digital. You have an advertising revenue that scales with inflation against fixed SGA. I think people forget that in the 1970s, if you look at all the sectors that did well, everyone likes to talk that oil was the best performing sector, followed by gold. People just forget that newspaper was the best performing sector. It's just not in those those charts that people like to pass around. You have these regional monopolies with really deep moats. Most markets have 1 or 2 papers, but most markets outside of New York really have just 1 paper. You have trusted access to local consumers. Newspapers still, even while media has gone toxic in terms of television media, newspapers still have decent levels of trust. You have access to subscribers in a world where tracking cookies are going away. All these newspapers now can tell exactly what articles you've read, what your interests are. It's really a unique marketing function, and I think they're just starting. I really think a company like Lee is very much like Facebook right after the IPO, where they had all these eyeballs, they didn't know how to make money at it. And Lee is investing dramatically in tech and their ad tech, their whole tech stack. And it's holding back the EBITDA this year. But I think the net result is that they just make a ton more money. And it's a natural consolidator in an industry where a lot of local papers are owned by a family. And these guys can go in there with their tech stack, with their R&D budget, and buy these newspapers that are really struggling for pennies on the dollar. And I just think it checks all the boxes you want in a consolidator. We're consolidating an industry at like 2 times cash flow. And, of course, Chad from Reddit would tell you this deserves a SaaS multiple. I mean, it checks all the boxes as a subscription digitally native business. Does it get a SaaS multiple eventually? I don't know. We could always dream. But, I just think it's a unique time to own Lee as advertising just crossed and it's likely to accelerate. Anyway, I think I got like 2-3 minutes left. If you want more information about me or my or Kedem, please subscribe.
Yeah, thanks, Guppy. We have a couple questions that came in. One of them
Great.
was, why is the EBITDA to free cash flow conversion so weak over the past year?
Couple things. To start with, there's a lot of interest expense. They've invested a lot. They invested over $30 million this year in growing out their digital platform. This is a big working capital build. Q4 is always their best quarter. So there's a kind of a working capital build and they kind of drain it in Q4, plus they get better advertising in Q4. And honestly, they've underperformed a little versus where they were last year. If you think back, last year you had, peak COVID, you had, just an election cycle. You had a bunch of things that were happening that aren't happening this year. So, you just have a lot of people that they finally got out of their house and they're going out exploring. They're not on their iPhone reading the news, and so advertising came off a little, whereas subscriptions really accelerating.
Okay. I have another question. It's more of a one from me. I know you obviously love energy. I think you also love uranium. What other kind of themes or areas do you like right now?
I really love energy. I think it's the best one. I think uranium is just as good. I like housing, though. It's kind of having a little bit of a pause because J-Pow's taking rates to infinity. But in the end, if you take rates up high and rents keep going up, you're still better off buying. And I think a lot of people end up buying. Those are the main sectors I like. Then I own a bunch of companies like Lee that are going through this analog to digital transformation in the media sector. I think a lot of these things trade at less than 1 times cash flow or EBITDA, whatever metric you want to use, looking out like 2 years. And they're really, monopoly businesses in their regional markets, and monopoly businesses that are growing quite rapidly. I mean, go back to how rapidly Lee is growing. I mean, monopoly businesses growing like this don't usually trade at 1 times EBITDA. It's the wrong price.
Well, thanks, Harris. I appreciate you spending the time with us. I appreciate you finding a microcap that you could present with as well.
It's close enough.
It is. It was good. Thanks, man. I appreciate it.
Sure thing.
Okay, our next presenter is Sid Grover. Sid, are you with us?
Yes. Can you hear and see me all right?
Yep, I can see you.
All right, let me try sharing my screen. Can you see my screen?
I can see your screen. Yep.
All right, fantastic. All right, well, it's a pleasure to be here. And I'll be talking today about a company called Tidewater. So just very briefly on myself, because I really want to get to the industry and the company. Was born in the Midwest, raised in India, spent high school and college in the Bay Area, moved to Texas about a year ago. And academically and professionally, my background is in enterprise software. I co-founded and built a vertical enterprise software company in the higher education space called Infinity. If any of you have children taking introductory calculus or physics at an American university, there's a good chance they're doing their homework or tests and quizzes on our software. But my day-to-day focus now is primarily managing a private investment vehicle that's mainly principal capital. And I'm a little lucky to go after Copy in that he did all the hard work of articulating this much more eloquently than I can or ever will. But essentially, most of my focus is on macro-driven equity investing, which is finding conviction in these macro trends near cyclical bottoms. But at heart, I'm an equity analyst. I don't generally express views through futures or derivatives or anything of that sort. I like to talk to management teams. I like to look at balance sheets and evaluate companies as equities. So expressing those macro views through equities. And so some examples of themes in the last few years that worked well for me: thermal coal, metallurgical coal, also known as coking coal, oil and gas E&Ps, and an example of one that worked out very poorly for me, which I did very badly on, was North American steel producers after the invasion of Ukraine. So today I'd like to talk about Tidewater, and the macro theme in essence is offshore oil capex. And so what Tidewater does is that it operates the largest fleet of offshore service vessels, abbreviated OSVs, in the world. And these are essentially specialized vessels that provide services to rigs engaged in offshore oil exploration and production. So they look like this picture on the bottom left, and they provide services to offshore oil rigs like the picture on the bottom right. So first, the philosophical question to quickly answer is, why is this an interesting macro trend or theme? And then we'll come to talking about OSV supply-demand fundamentals. But the salient reasons as to why you'd want to bet on an offshore oil capex upcycle: first, almost half of proven oil reserves owned by majors are offshore. Two, there is a natural decline of about 7% per year in global oil production in the absence of capex. And this red box on the left highlights the gap between expected oil demand for various oil forecast scenarios versus this black curve, which is where we'll end up in the absence of further investment. And so there's a lot of investment that will need to come in order to bridge that supply-demand gap. We're starting to see at the moment the consequences of ignoring charts like this. But this, combined with most of the reserves being offshore, or at least half of the reserves being offshore, nearly half, means that offshore oil capex will likely have an upcycle if the oil market is to balance. And that isn't true just of production, it's also true of exploration, in other words, new oil discoveries. So as you can see, about 12, 13 years ago, before ESG starved this industry of capex, of capital and investment, we were discovering almost 2 times as much oil as we consumed in any given year. In 2019, we had discoveries of about 13% of global oil consumption. And so if that normalizes, again, that means more capex. Finally, offshore oil break-evens are very competitive in a range of oil price scenarios. So you're not really taking on an immense of oil price risk. This is a few years old, so it may not be perfectly correct pro forma for cost inflation, but the point is that as of a few years ago, so let's say there's been some cost inflation since then, over 3/4 of oil projects would have gotten sank. Offshore oil projects would have been economic at $45 to $50 a barrel. And the main reason for that is there's been a lot of cost rationalization in the brutal, not only oil bear market, but especially the offshore oil bear market, which at this point, this is from a presentation of an offshore oil rig company, so take it with a grain of salt, it's probably biased. But the point is that this wasn't necessarily true at the start of the shale boom, but today offshore is very competitive on a full cycle basis with shale in terms of cost. And there are a whole bunch of other potentially interesting ESG arguments for offshore oil, which I won't get into now. It's incredibly green in that offshore oil has a much lower carbon footprint per barrel of oil produced. So if there's ever a future world in which greener commodities trade at a premium, that again will be a very big sort of like positive for offshore. So we've talked a little bit about why offshore capex at a high level is something you'd want to be constructive on. Let's talk a little bit about OSVs. So I mentioned this earlier, they provide services to offshore oil exploration and production. There's a whole range of them, supply vessels, anchor and towing vessels that drag these rigs around, hold them in place, specialty vessels. You don't need to read this or really memorize any of it. The only point I'm trying to make here is that these are specialized vessels doing specialized things. You can't repurpose like a pontoon or a yacht to do what these boats do. They're relatively expensive. They cost $35 to $50 million per new build. They're highly regulated because, as you can imagine, transporting these kinds of materials in a highly regulated industry, they're built to certain specifications. They have expensive certifications that they need to go through every couple of years. So it's a market wherein you can't bring in supply from other maritime vessels. Now, what is the business model of these OSV companies? It's driven by day rates and utilization, and historically is a very simple and bad one. You spend a lot of money to buy boats, usually levering up the balance sheet to do so. You then contract them out to offshore oil operators or drillers at certain day rates, which is like a revenue per day. Think of them like a car rental company, renting out cars, except they're in the water, either on contracts, which are called charters in this industry, or in the spot market. And these day rates are driven by the tightness of the market, which is reflected in utilization, which is the percent of the supply that is being used or is locked up at any given point in time. And when utilization is tight, day rates can increase parabolically because buyers are relatively price insensitive. And the reason for this is that OSV day rates, which bottom of the cycle were high single-digit $1,000, at the peak of the last cycle were $30,000 to $35,000 per day. This is a small cost of the daily cost of operating an offshore oil well. So that it's not a large percentage of the overall cost structure. So they're not going to make a decision to not use them or not, run a well that's active based on what the OSV day rates are. And the inverse of that argument is that downtime is very expensive for an offshore oil operator. And if they fail to secure their OSVs, a rig needs about 2 to 4 OSVs. Then they may have downtime, which is incredibly expensive. So, and the converse of this is that when utilization lessens or loosens, then day rates can fall precipitously. So in order to understand where we are today, we need to very quickly recap the last cycle, which tale as old as time. You'll see good times meant overinvestment, oversupply, that eventually, brought about bad times. But these blue bars here is the offshore oil capex from 2003 to 2014, just up and to the right. So this meant that the offshore rig count was again up and to the right. Each of those rigs needs OSVs. And so for this period leading up to 2014, utilization, focusing on this red box here, was tight. It was about 90%. And even though OSVs were being built and entering the market, that's this dark blue line at the bottom, because offshore oil capex was ramping so rapidly, those OSVs were getting contracted, they were getting engaged, and they were being utilized. But because the utilization was high and day rates were high, and these companies were drowning in cash, what did? They overinvested in new supply. And this shows the percent of the active fleet that was being ordered at any given point in time. So you can see in 2012, almost it's 80%. So basically for every active boat, there was one being ordered and built. And so what happened when those boats hit when those OSVs came onto the market? Looking at the dashed line here, there was a flood of supply, utilization fell. So supply increased. Not only did supply increase, demand fell precipitously. Because if you think back to the oil cycle, oil started to fall in 2014, coinciding with the shale boom. And so the light blue dots here are what was projected to be the offshore oil capex in these years. The dark blue dots are what actually materialized. So you can see the OSVs were ordered under the assumption of these much higher capex commitments, and they didn't materialize. So the rig count falls off a cliff, so went the OSV day rates. So 8 years of pain from 2014 to 2022. If you look at the stock price charts of some of these companies, it's a little bit of fun. This is chart crime because most of these went through restructurings and bankruptcies. So you can't really look at the stock price chart, but the point I'm trying to make is we're looking at an industry that is finally coming out of a very long period of distress, but it's now inflecting. Day rates are now at the highest this is for a specific class of OSVs, PSVs in the North Sea, but I'm just taking that segment as an example, we're seeing now that day rates are finally inflecting and they've reached where they were in 2015. Spot rates are going up, utilization's going up. So the active utilization is about 90%, and the total utilization is just about, kissing 80%. So what about that 10% slack? That's basically vessels that exist but are not active at the moment. However, and this is one of the things that you'll sort of like need to take me on my word on. This is one of the key things that you diligence and build conviction on when you analyze the sector, is that there are high barriers to entry, re-entry for stacked supply to come back onto the market. And basically, if a vessel has been stacked for more than a couple of years or has a total age of more than 15 to 20 years, it's not economical to reactivate it. And even if it is, there are many customers that, because of regulation and so on, they don't want older OSVs or OSVs that were stacked for a long period of time, because again, the risk of downtime for them is too high. And this is a quote from Tidewater's most recent conference call, where they basically make the same point that, if a vessel's been stacked for over 5 years or is over 20 years old, it'll be difficult or impossible for them to come back into the market. Again, this is from Tidewater, take it with a grain of salt, but it is consistent with what you will find if you diligence this market independently. And what that means is about half of the idle capacity is probably not going to work again. So where are rates today and where they're moving? Well, in their most recent conference call, which was around August, they talked about time charter rates being around $22,000 a day, up from 15 and 21, higher for the anchor AHTS segment. This is a trend that is consistent across geographies. And most importantly, we're starting to see this flow through their book. So they say that in the new contracts, that is the portion of their book that reset in Q2, averaged about $17,000 per day. So what does this mean for them? This is going back to the operating leverage of a fixed cost business like Tidewater. At $18,500 a day, which I'm just sort of rounding up from 17, they do about 666 million in EBITDA and 606 million in free cash flow. So again, to be clear, this is not an annualized figure of what they just made. This is looking at what price at which the parts of their book that reset repriced at, and then annualizing that across the fleet, because the expectation is that this tightness will either stay where it is today or ideally can become even tighter and day rates will move up. In fact, they have, because the Q2 figure was 17,000, but when they were talking in August, they already are quoting a higher figure of 22. Then we would expect the rest of the contract book to reprice over the next, 12 to 18 to 24 months. So the valuation map is relatively simple. And this is sort of the advantage of coming into these industries that are coming out of long periods of distress. When you do the napkin math, it's so silly that you don't really need formal price targets and multiples. But we're looking at an EV fully diluted today of around 1.43 billion versus this, I'm comparing it to that 606 million of free cash flow, annualizing the Q2 repricing rate. That's a 43% free cash flow yield. Now, what if they return to the 2014 cycle peaks, which was around 33.5 thousand? Well, that would be EBITDA of 1.62 billion and free cash flow of 1.47 billion. That today, at today's EV, would be a free cash flow yield of over 100%. And then this, I'm not even going to I didn't put these numbers up because they just look idiotic. But if you think about that state of tightness persisting for a year or two, and basically what you're seeing with coal today, wherein the supernormal period of earnings is lasting far longer than anyone thought, the pro forma EV, once this cash flow comes in and they delever, it starts to look a little silly. And could we see rates go beyond the last cycle peak? They make the point that during the down cycle, Tidewater actually high-graded their fleet. They scrapped and divested a lot of the older, vessels, a lot of the more commodity vessels that had less pricing power. So there's a good chance that we'll head to, as the offshore capex cycle recovers and supply disappoints, people become to terms more and more aware of the fact that a lot of this idled capacity isn't going to come back onto the market. There's a good chance, in my opinion, that day rates will go past the prior peak. But do they have to? They don't. Even if today's day rates, where they repriced the open contracts at Q2 at, even if that stays where it's at, I'll be a happy man. So as for a price target, apply a mid-single-digit EBITDA free cash flow multiple on mid-cycle earnings power, implies multi-bagger upside. This is probably conservative given that it's trading on teens trailing EBITDA and a high single-digit multiple of consensus NTM EBITDA. But with all of this divestment, ESG, and everyone's mandates shrinking and shrinking every year, I don't want to be betting on a lot of people being able to own this equity. So I'm fine just assuming a more conservative multiple. This is just reiterating the same point that they made, that they don't see supply coming onto the market. There are not enough boats to reactivate. There are not enough people to crew them. The same story you're seeing across the energy and commodity complex. And this market is likely to remain vessel constrained for the foreseeable future. Another important question to ask when it comes to these cyclicals that have a history of incinerating capital: will shareholders see the cash? If you take the CEO at his word, what he says verbatim is that he believes businesses are made to build cash and return it to shareholders, and that he feels that they're under-levered at the moment. Personally, I'm fine if they do a little bit of M&A, because the M&A they've done in the last few years, including their acquisition of SPO earlier this year, was incredibly accretive. So I think they've done good M&A. So I'd be fine if they did it, because I believe in the longevity of this offshore cycle. But in the absence of that, I think their default course is to return it to shareholders. There's a question sometimes asked as to why we don't buy the drill ships or the rigs, like the Transoceans and Valarises of the world. This is the point that was actually, I became aware of this based on an interview that another panelist made, another panelist, Josh Young, did with Fergus Cullen a year ago. But there's left tail risk to offshore drillers, in that if there's a well blowout like the BP disaster, the equity is likely to be a zero, because these companies don't have liquidity or insurance to cover the likely environmental liabilities. I actually think the structural supply demand setup for drill ships and rigs is even better, but I'm not a terribly large fan of left tail risk. And the left tail risk with OSVs is much smaller and much weirder. So I own these OSVs because I think it still has enough torque, but I sleep better at night. And not only that, we can feel a little bit about the fact that OSVs helped out, when rigs have problems. This is why they're so essential to the offshore oil complex. So yeah, that's the presentation. If anyone has any questions, please feel free to email me or shoot me a DM on Twitter. I always love exchanging ideas. And thank you, Michael and Ian, for the opportunity to present this idea.
Sid, just a couple questions. Are you long the equity or the warrants?
I'm long the equity.
Okay, and I'm curious, what were the multiples of companies like this during the last cycle peak? Well,
the principal model is that there was a lot of speculative ordering of vessels without contracts to back them up. So people just assumed that offshore oil capex would just continue to ramp forever, and they were just placing orders for these vessels without any guarantee that they'd be able to be placed and they'd be able to get locked up. And what you're hearing now, there's another offshore OSV company listed in Australia, Mermaid Marine. If you go and read their most recent conference call transcript, they explicitly say that they will not order a new vessel unless it's secured by a long-term contract. So it's really a change in capital allocation mindset that is different about this cycle.
Okay. All right. Well, thank you, Sid. Appreciate it. Thanks for participating.
Thank you.
Okay. I believe next is Paul Andriola. Paul, are you there? I think you may be on mute.
I was on mute, and now I'm not.
There.
All right, perfect. Let's see if I can get my screen to share properly. All right, Ian, can you see it?
Yeah, looks great.
Awesome. Awesome. Well, thank you. Well, Ian, thanks. Thanks, Michael, as well for allowing me to present today. It's always fun to catch up with you guys. My name is Paul Andriola. I, along with a gentleman named Trevor Terweek, run an organization called Small Cap Discoveries. And really what we do is we work to discover sort of nano caps and micro caps, predominantly in the Canadian public markets. It is an unfriendly market every now and then, but from time to time we find something that is worthwhile talking about. So let's see here. There we go. Okay, so what exactly do we do at Small Cap Discoveries? It's a discovery and stock picking process that we've defined over the last, well, I've been at this for about 30 years, gained experience from, being a private investor. I've been a broker, an investment banker, and also spent time involved in startups, both from founding companies all the way to taking them public. And currently sit on the board of a couple companies. So I've, gained a fair bit of experience from being in all different areas within, running a business, as well as capital formation around companies and financing these companies and eventually taking them public. But what we found over those 30 or so years is that if you're looking for success in specifically the microcap space, you can lessen the risk and increase your chances of success by sort of defining a small subset of criteria that allows you to get what everybody's hopefully looking for in the microcap space, and that's these multi-baggers. So I'll speak a little bit about the process as we go here. First off, okay, so what is it? What is this discovery process that we talk about? It is sort of discovering these early stage companies that typically are less than a $50 million market cap, but very undiscovered by the capital markets. Traditionally, companies get discovered either because somebody's promoting the business or an investment banker is helping to raise money for a company. We're looking for those orphan companies that traditionally are making money, so don't need the capital markets, don't need the investment bankers, and are really not being promoted because they're just too busy, running their business. Why do we do it? Well, we do it because we can make money from it. It's been lucrative for us. I can sort of highlight a couple of the companies that we've discovered in the process a little bit later, but it is really an opportunity here to find significantly mispriced opportunities. And one of the other presenters, Matthew, earlier said something that really resonates with us. In the microcap and nano cap space, especially in Canada, a lot of times you are competing with inexperienced investors and sort of the unprofessionals. And we think we've got a big edge by sort of having a disciplined criteria within that market cap and in that space. So the process, what we do is pretty, it can be pretty boring, but we go through every CDR filing. So every financial filing in Canada, we review that on quarterly, well, daily basis, but we're looking at quarterly filings, and we're looking for companies that meet this criteria that we go through. So we don't use any automated screening processes. We don't use software. We literally manually go through every single filing in Canada. And, we can quickly look for the key things we're looking for and go through a number of companies very quickly. We do that on a regular basis, but also at least twice a year, we'll go through every filing A to Z to really discover, what we're looking for. So we do it the old school way, the old fashioned way. Who does it work best for? This really works best for smaller investors. Institutional investors cannot come down market. In some cases, we've bought stocks, with microcaps of less than $5 million. So, a small amount of capital being allocated here is actually an advantage as opposed to those with a larger amount of capital. It also works best for those that really understand that they're buying a business, or that's the intention. You have to have a longer term time frame. You got to be less concerned with short-term price movements, and you also have to be prepared that in a lot of cases these stocks are very illiquid and they have very, very little exposure. And as far as the performance, we don't sort of track portfolio performance, but we can tell you that we've identified. I certainly have identified about at least half a dozen stocks that have turned out to be 100 baggers. And on a regular basis, we've discovered a lot of companies that are, the 10 to 20 bagger type of stock that hopefully everybody is looking for. Okay, so a little bit more about the process, a little more details here. When we do go through these CDR filings, we're looking for companies that are growing their revenues by at least 25% on a per share basis. Clearly, if they can grow faster than that, we're looking for that, but it's important that we're looking at it on a per share basis. We don't tend to get too involved with companies that are doing a lot of M&A and are growing their revenues, albeit they're also growing their share base. So we're looking for smaller share count, but a good revenue footprint from that share count. We're also looking for profitability. We're looking for early stage inflection points. So what we find is if we can see at least 2 quarters of profitability back to back, then we think we've got something that is not a one-off, and something that at least with 2 data points looks like it's the start of a trend. So we want to see this consistent revenue growth. We want to see profitability. Very, very few companies in Canada, certainly in the microcap space, are profitable. So immediately that screens it down to about 5 or 10% of the available microcaps, probably even less. So we're looking for profitability, and then again, size. We're looking for companies that are under $50 million market cap. In the last couple of years, we've actually invested in a couple of companies that had less than a $3 million market cap. So we're looking at the real nano cap side of the market. Why are we doing that? Well, part of it is because, again, you're competing with inexperienced investors. Institutions are not down market, and ultimately we want to be selling to the more experienced investors in the institutions. So that's kind of what we're doing there. And on the side here, I mentioned sort of the process. We do go through CDR, and CDR, similar to Edgar in the US, CDR is where the repository for all the filings in Canada are placed. It's a very clunky system. We love the fact that it's clunky and unappealing, because it makes it a little bit less appealing to other investors to look in that and do what we do. Okay, so just a few of the names that we've found over the last several years. The one that sticks out the most is XPEL. I was fortunate enough that we discovered XPEL below 20 cents, and that's when we started building our position. That was a company that was growing very quickly, clearly still is. But back at that price, the company was growing its revenues by over 100% on a year-over-year basis, was trading at less than 10 times earnings. And very few people were following it. One of the other interesting aspects of that, why our system worked well, was because it was a US dollar denominated stock on a Canadian exchange. It did not show up very well on a lot of the software screening programs. So we were able to find it early, and a lot of others just simply didn't find it. But a lot of the other names there went on to be, in some cases, 100 baggers plus. So clearly, looking in this part of the market where we are, we can find some really, really good returns. Okay, so the company I want to talk about fits the bulk of the criteria we look for. Company is called CPRO. It stands for Serial Advanced Processing. This is a life science / consumer product company. It's based here in Canada. It's located in Edmonton, in Alberta. They have a state-of-the-art GMP manufacturing facility that manufactures their own products. The products are sold. They're sort of components of some major household brand products. There's a good chance that you have some of these products in your shelves. So yeah, sold to major brands across the world. And it really what they're able to do is they can process plant-based material and extract very high value products that are used in everything from sort of cosmetics, nutraceuticals, and in some cases biopharmaceuticals as well. Okay, so part of the reason we like this business is that there's really two components to it. One is the sort of the core revenue generating component of the business, mostly two products that are sold in the cosmetics industry. Very good, solid core business. The other key part, apart from this profitable core business, is the sort of the optionality, if you want to call it that, but the ability to generate new products and high value new products while being sort of funded through the existing and excess cash flow of the business. So, new and novel products that are coming to market that have the potential to be extremely high value, and in addition to the core products that they have right now. Okay, so as far as the revenue trend, these are the sort of charts we like. We like to see them consistently go from the bottom left to the top right, and that's what's been happening. The two core products generate the bulk of the revenue. As you can see here, it consistently going higher. Last year was a record year for them in terms of revenue and profit, and so far in the first half of this year, they're on track to have another solid record revenue a year, as well as record profits as well. A bit of lumpiness over the course of the last several years in terms of profit, but that is partly due to money being reinvested in the business and some of the high profile products that are on the shelf right now that are hopefully going to get commercialized. Extra R&D being spent on getting those products advanced. And some of those products do include biotech or drug style products that are going through at this point mostly clinical or preclinical stage trials, but soon to be in the clinic, and potential for very, very high revenue from these products if they're successful. So a few details. Okay, so last quarter revenue grew by 25% over the year ago period. If you take the trailing 12 months, the revenue grew by 29% over the last 12-month period. There is a little bit of lumpiness in some of their sales, but if you average it out, it's pretty consistent. Earnings or profit increased by 146% this quarter over the same period last quarter. We've now seen 6 quarters of consecutive profit, so there is some consistency here, and like I said, the trend continues to go in the right direction. Somewhat low issued and outstanding shares. The company has about 78 million shares outstanding, which is a little bit higher than we tend to like, but nevertheless, market cap still fits under that $50 million mark that we're looking for. Okay, so just a little bit more of the same thing I just mentioned, but the only real difference on this slide here is the insider ownership is just shy of 10%. We prefer to see an insider ownership that's a little bit higher, a little bit over 10% is kind of what we look for. So if anything, this one's got a little bit lower than we want to see. There are no warrants outstanding. As far as the cap structure, there are about 3.5 million. Here we go. There's a slide with that. 3.28 million options outstanding. So fully diluted, you're looking at about 81 million shares. Current price 72 cents. This is all in Canadian dollars, by the way. You can see the high low there. Market cap 45 million. But okay, so last year, trailing 12-month revenues, they did just shy of 19 million. Like I said, that was up about 29% from the year ago period. Profitability, 4.3 million in trailing 12 months, 6.6 million in trailing 12-month EBITDA. Very healthy balance sheet for a company this size, just shy of $9 million in cash, no debt. As far as yesterday's closing price of 72 cents, the stock trades around a 10.4 times trailing 12-month PE. And if you were to annualize this last quarter, you get your 6.8 times PE ratio. So that's kind of it. Like I said, really the piece we like here is the core growing business and the two main products that they have, which are both, by the way, oat-based products, avenanthramides and oat beta-glucan. If you have Aveeno skin care products, if you have Neutrogena skin care products, a number of products from Jergens and Johnson & Johnson. These are all the brands that carry their oat-based products. So that's kind of it in a nutshell. But we like the product, we like the business because it's got that good core, solid, growing business, and then the sort of call it lottery ticket generator with the new products that are going through the different phases of trials right now.
Thanks,
So,
Paul.
yeah.
I had a question that came in. So on the current run rate of earnings, is that sustainable, or do they have to spend quite a bit to push further products kind of through to monetization? How should we think about that?
Yeah, so there will be a little bit extra spend, but they're pretty adamant that they're going to continue to be profitable. Although I would expect in the second half, there's going to be a little bit more spend, but they did over $4 million in the first half of the year. I would sort of suspect that they'll probably spend an extra $1 million or so out of the bottom line. So it should be a slightly lower profit in the next quarter. The nice thing about the products they're pushing out is a lot of them are they're relatively low cost to get through the various trials that they have to go through. And there are partners that are prepared to take a spend if they can get through different milestones. So unlike a lot of other biotechs and life science companies, the spend that they need to do to produce these things or getting commercialized is very minimal. So I suspect they're going to continue to be extremely profitable. And fingers crossed that they get one of these across the goal line, because they could be a pretty nice win for them.
Okay.
Mm-hmm.
Well, thank you for presenting. Appreciate it, Paul.
Thanks for having me, Ian. Pleasure.
Thanks.
Talk soon. Bye.
Okay, our next presenter, I believe, is Michael Liu. Michael, are you there? All right, let's give Michael a couple of minutes. We are a couple of minutes early. Give us a couple more minutes, folks.
Hey, Ian. Sorry.
Yep, no problem.
All right. Let me just get my screen shared here. One second.
Oh, we may have lost him. There we go.
Can you see this? Yeah. So sorry about that.
No worries. We got done a little early. Previous one.
Okay, sure. Yeah. Really sorry. Yeah. So yeah, hi everyone. First I want to say thanks to Ian for inviting me to present and organizing this conference. I know it's a lot of work, on the back end. Today, this is my presentation on my investment process and the companies I look for. So, to get started, looking at sort of a broader perspective of the microcap landscape, my view is that sort of, if you look at a lot of microcaps out there, a lot of them are generally pretty low quality businesses. And I think a lot of this is a function of the fact that it's rare to find new IPOs in the microcap space. A lot of the times, how companies become microcaps are that they start as bigger businesses. They, the share price falls, they have some operational hiccups, and that's how they find themselves in the microcap space. So by definition, companies in the microcap space are generally low quality businesses to begin with. But that also creates a lot of opportunities because small companies have more leverage inherent in their size. So when you're, just like a $10 million market cap, it only takes $20 to $30 million of value creation to move, the stock up 200 to 300%. So, and at the same time, investors like this dynamic because smaller companies are much easier to bid up. At the same time, company managers, I think, also like this, which is why you see a lot of the times very high quality managers from larger companies come into the microcap space because they want to acquire, they want to have their name attached to an 100 bagger. And the best way to do that is to take control of a very small company, execute, some sort of a turnaround, and then, create a lot of value that way. And microcaps are also, like I said, like it says, easier to pivot operationally, so that attracts the big managers as well. So you put these two to get things together, and basically what it means is that microcaps are weak businesses, usually most in need of a turnaround. And at the same time, they also benefit the most from an operational turnaround because there's so much leverage to their small size. And that leads to, what I look for in small microcap businesses, which is basically summarized by unique assets on the brink of inflection. This, that's like sort of the thesis statement. And to start with unique assets, what unique assets means is basically like competitively advantaged assets. So assets that have some sort of competitive advantage. This can be from, capital, for example. A lot of times in microcaps, you see companies that have, plants or software platforms or something that they spent hundreds of $millions building from, a prior business. And, that's when you get the fallen angels, where they're failed to monetize it. And now they're a microcap with, a very valuable asset that they just don't know how to monetize. And then, there are regulatory competitive advantages. Customer relationships are great competitive advantages. A lot of times you see, microcaps with the business model where they have very high quality customer relationships, and all they need to do is, in-license or acquire new products to push into those, into that customer base that they have. Time is also a very valuable competitive advantage sometimes, especially in, validation. I have here is more relevant in higher risk industries. So like when you think about aerospace manufacturing or medical devices, those parts suppliers are typically very entrenched because there's a high value to quality in manufacturing in those industries. So, a long-term track record of high quality products is very valuable there. Network effects, basically it's anything that any of the typical competitive advantages are valuable because in the stock market, so like, when I talk about unique assets on the brink of inflection, it's not about just creating a new business out of thin air. That's angel investing. You can't just make something out of nothing. The valuable part about the stock market is that you're able to buy into these companies after they've already spent tens of millions of dollars of capital and several years developing these unique assets. And you can usually buy into those companies at a fraction of their replacement cost because they've just been unable to monetize these unique assets for a long time. And that brings it to the second part of the sort of thesis statement on the brink of inflection. The inflection point is something happening to the company to allow it to finally monetize those assets. So the best way to sort of like mentally frame this is there's three main parts of a company the way I see it. And that's sort of like recognized in the three different expenses that a company typically has. So the cost of goods sold, which is their product, which is what they sell, that's one part. The sales and marketing structure, that's how they sell the product, that's another part. And the general administrative expense, which is the management team that manages all of this. And basically one or more of these things have to change in order to create that inflection point to realize the sort of hidden value of a company's assets. So that can be a strategy change, like a sales strategy change. A lot of software companies in the last couple of years have had a lot of success pivoting from one-time license sales to a recurring SaaS model. Sometimes the product needs to change. Sometimes the sales and marketing arm is very high quality. The management's high quality, but they're just selling the wrong products. So sometimes the company just needs to in-license or acquire new products to sell and give to those the valuable people that are already at the company. And then obviously a very big thing that we look for is management changes, where the general administrative side of the company changes. So this is like activists coming in, installing new CEOs, when there's large board of director changes, anything like that. Basically, the general idea is just that, some structure or strategy of the company needs to change to unlock the value of these assets. And that's like sort of the theoretical overview of it. In terms of day-to-day research, which is, the sort of down-to-earth portion of this presentation, 90% of what I do is basically just screening for new companies at the point of change. So this means, looking for CEO changes right when they're announced in a press release, looking for company strategy changes right when they start talking about them in the company's conference calls. And in doing this, it's important to the idea is basically to get to understand it and find these inflection points first and fast, because like I said before, microcaps get bid up very fast, and discovery is, the discovery portion of when a new great company is found can be aggressive. So, the purpose, sort of to summarize all of this, is that doing this research is to sort of keep a pulse on the microcap ecosystem, sense when interesting new things are happening. So when unique assets are on the brink of an inflection point, and be the first to find and fully understand these opportunities, both by, finding them by just looking brute force through all of the news that comes out of the microcap ecosystem, and understanding them by, doing the management calls, the channel checks, all of the classic sort of industry due diligence that people do. And here's a list of resources that I could come back to. I won't go through all of them. It's just like the first bullet point, or the first few bullet points, are just places to track microcap press releases, and the rest are places to track insider buying, which are typically concurrent signals of a strategic change going on in all of the English-speaking countries around the world. And then getting to the stock pitch, the company I'm pitching today isn't quite new, but it is on the brink of an interesting inflection point. The company's called Cogstate. Cogstate's profiled on the forum, but I think the thesis has evolved a lot over the past couple of years. So Cogstate makes cognitive tests for Alzheimer's. Their tests are used in Alzheimer's clinical trials to test, they just give these tests to patients repeatedly to see if the patient's cognition is improving and if the drug works. It's a, relatively solid long-term growing business, as you can see in the below chart, but I think it's on the brink of a very aggressive inflection point in revenue growth over the next few years, and I'll get into why now. So looking at the business as a whole, they're a market leader in this. They're one of those companies that has the unique asset of time and validation, in that they've been in this space for about 20 years. and they have very deep customer relationships with big pharma in Alzheimer's. So it's a very entrenched business, basically. It's very unlikely that another company or another competitor catches up to them. They ride a couple of major tailwinds. Alzheimer's R&D generally grows over the long term. That's just because, Alzheimer's, I believe, is the largest untreatable killer in terms of diseases. So pharma has a big incentive to do Alzheimer's R&D into Alzheimer's drugs. And there's a long-term shift away from sort of legacy forms of cognitive testing to computerized testing, where Cogstate is the leader, and this has been accelerated by COVID. So that's sort of what's driving the historic 15 to 20% growth. That's, sometimes lumpy, but mostly consistent in Cogstate's history. Today, they trade at about 15 times EBIT with a large amount of cash, which is a discount to comps and a pretty reasonable multiple, I think, for the growth that they've achieved and the space that they're in. But what makes the thesis more interesting is the inflection point that's upcoming with several late-stage Alzheimer's drug readouts over the next 1 to 9 months from basically all of the big pharma focused on Alzheimer's R&D. And Cogstate has very strong relationships with all of these companies. The way that these readouts for these drugs affect Cogstate is basically, if any of them individually fail, it doesn't really make a difference to Cogstate's business, because that pharma will just scrap the drug and start researching other drugs. But if their readouts are positive, that greatly benefits Cogstate because of 2 reasons. First, if there's a successful Alzheimer's drug, there's going to be a lot more clinical trials conducted both with that drug and with fast followers trying to copy that drug's mechanism of action to make their own sort of new or better version of that drug. To put this into perspective, the first drug reading out is Eisai's drug lecanemab, which reads out near the end of September. Them and their partners have said publicly, if that drug is successful, they're looking at 3 to 4 to 5 combination therapies, so pairing another drug with their drug to initiate new phase 3 trials for those combination therapies at the end of the month. And so for a phase 3 trial, if Cogstate does the work on them, they get about 5 to 15 million of bookings immediately. And there's 3 to 4 or 5 of those. And this is, $5 to $15 million of bookings, 3 to 4 or 5 phase 3 trials is very significant compared to the Cogstate's trailing 12 months bookings, which are like 70 or 80 million. So you can see there's already aggressive growth potential there. At the same time, Cogstate is currently partnered with Eisai for Eisai to roll out Cogstate's test as a direct-to-consumer test for Alzheimer's. So basically taking Cogstate's tests out of the clinical R&D side and putting them into a patient's home to screen patients for Alzheimer's. So then more people are screened for Alzheimer's and diagnosed, more people want to use Eisai's drug. Basically, Eisai is positioning so that if their drug lecanemab is successful, they are going to start aggressively rolling out Cogstate's test to hundreds of millions of patients worldwide as a direct-to-consumer screening test, and Cogstate gets, a $2 to $3 royalty on that. So that, again, that's like a, multi-$100 million revenue and pure profit opportunity. And I think, putting all of this together, Cogstate has grown at 15 to 20% historically. I think if one of these drugs is successful, which there's a very high chance of over the next 9 months, that growth could accelerate to 30 to 40 to 50% going forward at much higher margins too. And, lastly, there is a trading opportunity, I guess you could call it here, in that in the last couple of weeks, the stock has gotten hit hard because of just basically, I think there's no fundamental reason. It's basically just a seller-buyer imbalance where nobody wants to buy ahead of what they consider to be binary readouts of these drugs, especially Eisai's drug at the end of this month. So, it's an interesting opportunity to buy the stock with a long-term perspective. And if you're willing to hedge the decision by just shorting or in some way shorting Eisai or their partner Biogen into this readout. But, all in all, I think basically Cogstate is on the brink of a multi-year inflection in Alzheimer's R&D that's going to start potentially as soon as the next 2 weeks. And that could, multi-bag this business. And in the event that all of these drugs fail, there's probably limited downside to the stock anyway, because they trade at 15 times EBIT, growing still, 10 to 15 to 20% per year. And they'll keep doing that throughout anything that happens. And with that, I'd like to thank you. And if we have time, I'd be happy to take any questions.
I guess the one question that we had come in, Michael, was about, there's a Canadian company called Cognitivity working on a similar technology. And so maybe it's probably a good question, is about just the competitive nature in the digital cognitive screening area. You know, you have Cambridge, you have Cogstate, you have other things like Cognitivity. Like, how do you think about that?
So my understanding of Cognitivity is that they don't play really in the clinical trial space. There are some, there really aren't a lot of competitors that compete in terms of having computerized tests that compete with Cogstate in the clinical trial space. So that, which is, almost 100% of Cogstate's revenues and earnings today, is not relevant to that space. It might be relevant to the direct-to-consumer space, so acting like that as that screening test, like I said, with AZI. But even in that space, I don't. It's hard. It's very hard to compete with Cogstate because Cogstate has such long-term relationships. So Cognitivity doesn't have a partnership like Cogstate does with AZI. AZI is a $20 billion pharmaceutical company that's willing to put a lot of resources into rolling out this test. I believe Cogstate or Cognitivity and other competitors, none of them have this sort of big pharma partnership. And at the same time, none of them have the amount of sort of industry validation. So Cogstate's been used on clinical trials for years and decades, and very large scale clinical trials with lots of academic studies done. None of the competitors that I'm aware of have that level of validation, besides maybe Cambridge, but Cambridge isn't really pursuing the opportunity. So, basically when it comes to that, the direct-to-consumer space, Cogstate's the only company trying to really, tackle it head on with funding, with actual amounts of funding.
There's another question. How do you handicap the risk of a general R&D downturn in Alzheimer's, leading to less trials invested in the disease, phase 3 trials fail?
Yeah, so that's that would be the possibility if all 4 drugs over the next 9 months fail. Then it's possible that the industry starts investing less in drugs that use this specific mechanism of action. But again, you can see historically in Cogstate's bookings, that is sort of what happened in the 2018 to 2019 area. And that resulted in basically 1 year of downturn in terms of bookings for the business. And that was when, a whole host more drugs than what currently is out there, than the 4 drugs that are reading out over the next 9 months failed. Today, the industry is much more diversified in terms of mechanisms of action. So, I think it's about 50% of Alzheimer's drugs in the R&D phase right now are not related to amyloid. So like what happened during 2018 and 2019 was a bunch of amyloid focused drugs failed. And then companies stopped making amyloid focused drugs, and they started pivoting to other sort of mechanisms of action. So I think going forward, what's going to continue to happen is that companies use different mechanisms of action. It's more diversified. If one drug fails, it doesn't necessarily mean anything for the rest of the industry because they're all trying to go about Alzheimer's in different ways. The issue back in 2018, 2019 is that everybody was trying to use the same mechanism of action, and then they started doubting the fact that it would or wouldn't actually work.
Okay, well, I think we're up against the time slot. Thank you, Michael, for the presentation.
Sure, thanks so much.
Okay, I think our next presenter is Adam Wilk. Adam, are you there?
Yeah, can you hear me?
I can.
How's it going?
Great. Thanks for joining us.
Yeah, thank you very much for including me. I always enjoy this event every year, and the quality of presenters and pitches so far has been phenomenal. So thanks for letting me join. I'm going to be pitching Consortium, and I can start whenever you guys are ready.
Yeah, go ahead.
Great. So I guess I'll back up and talk a little bit about Greystone. So my name's Adam Wilk. I'm the founder and portfolio manager of Greystone Capital Management. The firm was founded in 2019, and the sort of pitch book description is that it's a long-only equity-focused RIA that utilizes a fundamental research process that's focused on identifying mispriced small and micro-cap securities. And client portfolios are invested in a concentrated way, where we typically own between 10 and 15 stocks at one time, depending on the opportunity set. And I have a really non-traditional background. I started my career in the sports world, actually working in professional basketball for a number of different NBA teams in a scouting and operations role, or scouting and operations roles over the course of a number of years. And made a pretty hard career pivot about a decade or so ago when I was introduced to value investing, and was every bit bitten by the bug, as they say, and I've kind of gone down a crazy rabbit hole, I guess, since that time period. And while I was, I guess, learning how to invest and exploring the industry and trying to figure out how to sort of make my mark in terms of a career, I sort of always knew I wanted to end up on my own, but I spent an inordinate amount of time trying to meeting with investment managers, wealth managers, financial advisors, fund managers, and trying to determine, I guess, how many of these people or which group of these people were setting themselves up for long-term investment success. And that process was based on interviews and conversations and passing notes along, and lunches and drinks and all that kind of stuff. And I basically walked away from that sort of multi-year period with the understanding of, I guess, how I wanted to build an investment firm. And I wanted to do so in a way that was differentiated from some of the larger firms and funds out there. And at a high level, some of those differentiators include being a one-person investment committee. I'm the sole portfolio manager and analyst. At some point, that will probably change due to the research bottleneck, but there's no investment committee. There's no sort of process weighing down decisions, and I can kind of move with, I guess, be a little bit more nimble and quick. Well, like I mentioned, client portfolios are invested in a concentrated way, owning between, this says 9 to 12, but it's about 10 to 15 stocks, depending on the opportunity set, with the top 5 ideas making up probably 60 to 70% of client portfolios. I'm really only focused on best ideas only, so I really want to base the process around deep fundamental research, getting very familiar with the businesses that I'm in and industries that I'm interested in, and then weighting those positions appropriately to have maximum portfolio benefit. And then going along with the concentration, really try to avoid diversification. I think everybody knows the sort of claim that you achieve as much diversification as you need after maybe about 20 stocks. And so I try to sort of stay a little bit below that area. And then the reason I'm here is because I love investing in small companies, and had some success very early on in my career in microcaps, and was sort of bitten by the bug in terms of that market cap size, and have just kind of fallen in love with the opportunity set. And the plan is to sort of cap assets at a certain level in order to preserve that opportunity set, which I believe gives people like myself a tremendous advantage, as everybody knows the benefits of investing in microcaps. And lastly, and most importantly, the portfolio manager and founder is incredibly aligned with all of the people who have provided capital to the firm, meaning 90–95% of my investable assets are in the strategy and always will be. And then touching on a little bit more about differentiation, don't have to read each one of these, but I came to sort of understand that not always, but AUM size can be an impediment to investment performance. And so, as I mentioned, my plan is to sort of cap assets over time to preserve a lot of the strategy elements that I think work in my favor. I tried to set up my environment to be really advantageous for picking stocks and doing research. The majority of my days are spent managing the current portfolio, but also looking for new ideas. There's very limited calls, meetings, or things that sort of get in the way of that, which I view as sort of research as being sort of the highest value add activities in investing. And, you know, there are calls and things with other investors and industry calls and expert calls and all that stuff, but that's sort of by choice, and that kind of adds to I consider that part of the research process. And then having the ability to invest anywhere, I think, is really important. The idea funnel, I think, is pretty wide, and, you know, I have things that I'm comfortable with and certain industries I avoid, but being able to look at any opportunity at any size in any industry, I think, is advantageous, you know, assuming I can get comfortable with those opportunities. And that just really offers a lot more flexibility, I think, as a whole. The strategy is fairly simple. As I mentioned, some of these aspects, it starts with idea generation and identifying small and microcap securities. There's a pretty, as I mentioned, a wide funnel. I try to turn over a lot of rocks. Over the years, obviously, you become more familiar with certain industries and businesses, and pattern recognition grows with experience. And so opportunities can be a little bit easier to filter through or say no to, I guess I should say. And so I really try to turn over a lot of rocks, and then over the years have built up a nice watch list of businesses that I've either owned before or have looked at but haven't owned, or where the price maybe got in the way or there's something missing. And so that provides a nice opportunity to sort of filter through those over time, and make sure I'm kind of hitting on or keeping up with those businesses and in the search for potential ideas. And then once I've found an idea, I kind of run it through my fundamental research process, which I won't get into in depth here, but it's really centered around developing a really strong understanding of the company, the management team, the industry. And then also trying to find some sort of maybe differentiated insight about the business that maybe isn't priced into the stock. And a lot of times in microcaps, nothing is priced in because no one's looking. And so that's one of the aspects I like the most, where you can have an opportunity to get really close to the management teams and really sort of wade in without competition and do your work and uncover those differentiated insights over time that nobody's finding or hasn't, I guess, found up to that point. And then at the end of all of that, assuming a company makes it that far, I'm really trying to sort of combine all of that work into a decision, if there is one to be made, where a company may make it into the portfolio with an extreme focus on, you know, downside protection, how much you lose if I'm wrong, and a continuous sort of evaluation of the opportunity. Client portfolios typically hold two types of investments: core and special situations. The special situations are pretty self-explanatory. That can be anything from management changes, refinancings or recaps, post-bankruptcy stuff, getting kicked out of an index, anything along those lines that there's a good company or maybe something attractive, but there's an element to it that, or some hair on it, that provides an opportunity for a favorable entry point. Those are typically sized a little bit lower and usually have a catalyst involved, I guess, due to the higher level of risk. And then core investments, pretty self-explanatory. Those are the sort of longer term holding, better businesses, cash generative, better management teams. And those are the ones that, you know, usually provide significant opportunities over a multi-year time horizon. However, lately, I have been finding a lot of special situations that I believe could turn into core investments, and those can be very attractive as well. Some of the boxes that I try to check at a high level, really focused on management. That's probably the most important thing. In microcaps, they can drive a lot of the opportunity set. And then I really want strong unit economics, whether it's a retail concept or service business or a business-to-business company. And then the valuation obviously has to be very favorable. I won't read through all of these, but this is sort of the high-level investment checklist of mine. And if I check a lot of these boxes, I can usually move forward. And the research framework, once I decide to move forward, is centered around three things. I won't read this in depth, but in line with the unit economics, really trying to uncover a strong competitive position. Management should probably be first here, but really want to know who we're invested alongside and develop a relationship with the management team. They have to have open lines of communication, and I really favor owner operators. A large portion of client portfolios are invested behind management teams who own a lot of stock relative to their cash compensation. And then as mentioned, valuation. And then lastly, assuming a company makes it this far, depending on the risk reward, the asymmetry, the downside protection, core positions could get anywhere between 8 to 15% position sizes. And I'll sometimes let those run if the stock is working or the business is continuing to execute. And then special situations are usually in that 3 to 5 to 6% range, depending again on the opportunity set and risk reward. But really want to approach sort of the investment process as a, I don't want to say private business owner because we're in the public markets, but as somebody who is less concerned with maybe volatility in the stock price in the short term and more concerned with the actual business execution and what's taking place at the business level. And for more information, you can visit my website, look at the end of the pitch book to contact me, greystonevalue.com. So today I'm going to be talking about a stock in the cannabis universe. It's a pretty hated area right now and a really interesting one in my view. I've been doing a lot of work in the space and have come across some really cheap and interesting opportunities. Here's a little overview of the business. A market cap of 62 million, net debt of 56 million, and then an enterprise value, which I included here, the cash from outstanding options and warrants, which is a little misleading, but without those, I think the enterprise value would be around 110 million. Management is guiding for 90 to 95 million in revenues this year, which is up from 65 last year, and EBITDA of 20 to 25 million, adjusted EBITDA of 20 to 25 million, which is up from 19 last year. And so valuation at the midpoint of that guidance this year would come in at under 5 times at about 4.5. Put simply, I think the opportunity exists here, number one, because this is a microcap. There is one analyst covering the name. It's more of a general cannabis analyst than not company specific, so there's really no analyst coverage. The company is very small and therefore liquid, and this is a bit of a turnaround story. And then add in the regulatory stuff. Cannabis is still federally illegal. There's a lack of capital in the space, and sentiment is probably at an all-time low right now, following the sort of bubble from 2018 to 2020. And this last year has been really brutal for the industry itself and all of these stocks as people sort of do this dance with regulation. And before I get into the actual business, that's part of the reason why I like this space, is because the stocks don't really trade in line with like broader economic news. Obviously, consumer-based businesses are affected by high inflation and things of that nature, but there's a really sort of uncorrelated element here where a lot of these stocks and the industry itself sort of trade on regulatory news, and so they can provide a little bit of sort of a buffer to whatever else is going on out there, which is kind of what I like about the space right now and how I've sort of sized these in client portfolios. I've taken a little bit of a bucket approach, although among that or within that bucket, Consortium is the largest position because I think the opportunity set is very interesting. So at a high level, the Consortium is a cannabis stock, and it is one of the fastest growing, most profitable, and highest margin, cheapest cannabis stocks in the entire universe. The business is at an inflection point right now where I think a rapid increase in revenues and EBITDA is set to take place. The last 2 quarters, Q1 of 22 and Q2, have been record quarters, and the stock has barely moved. And there's been very little reaction to that. And the stock currently trades for less than 4.5 times this year's EBITDA and less than 3 times my estimate of next year's. And I think there's a really strong growth runway in front of the business and very attractive takeout potential. The company produces and sells medical cannabis in the Florida market primarily. The core market is the state of Florida, where they are vertically integrated, and they engage in cultivation, processing, retail, and distribution of cannabis. They have a number of different products, basically everything you can imagine in a retail shop, whether it's edibles, flower, vape products, cartridges, etc. And they provide their products under the Fluent brand name. And the company is actually in the process of changing the business name to Fluent So that should take place, I believe, by the end of the year. As of the last quarter, Q2, they operated 27 dispensaries in Florida, 3 in Pennsylvania, and then they have one. They exited their grow operations in Michigan recently, and they have 1 retail dispensary and grow operation in Texas, which is kind of not meaningful from a revenue or EBITDA standpoint. The business model is very simple: cultivate, grow, process cannabis, and then sell it via their retail dispensary network to medical patients in the state. As I mentioned, they are a bit of a turnaround story. There's been significant operational and financial improvements since 2019, including burdensome capital raises that were dilutive, expanding their cultivation network, inventory improvements, management changes, and actually avoiding insolvency while they were trying to build out their dispensary network. These improvements are behind them now, and the company, the fundamentals have significantly improved, and so has their market share, and they have an incredibly large opportunity in front of them to sort of continue growing that. As you can see here now, this slide says number 7, but they have the number 6 position in the state in terms of their ounces of flower sold and their retail dispensary network. Florida is responsible for about 85% of revenues today and around 100% of EBITDA. And revenues are, in my view, could grow above 25-30% into the foreseeable future, with EBITDA coming in the 15 to 20% range in terms of growth. Management strategy from here includes moving from that number 6 position to number 3 by continuing to increase their cultivation footprint, maximizing their current store base to grow their market share, and then continuing to grow their dispensary count. One of the interesting things about their guidance is that the additional dispensaries that are already under construction, I think 4 or 5 by the end of this year in Florida, are not factored into that guidance and will be very accretive or additive, I should say, from a top line and EBITDA perspective, with very favorable unit economics and pretty quick ramp times. You'll notice the debt picture, which I won't get into in too much detail. Market cap 60-some million, the debt outstanding, net debt is 56. It's been a little bit burdensome on the company over the years to try to get to where they are now. This is probably the most favorable position they've been in from a capital structure standpoint. And the interest expense is also a little bit burdensome. Unfortunately, that's sort of the state of financing in the industry, and there aren't many great options for refinancing at this stage. The debt matures in 2025. The interest is 13%. But the company is talking with a number of businesses, a number of family offices and capital providers to see what they can do in terms of providing more flexibility or growth capital. Having said that, they are free cash flow positive for the first time in their history as of Q1. And so they're self-funding. Growth CapEx and maintenance CapEx needs are fairly low, even with the dispensary build-outs. And so, and they also have entered into favorable leases where the capital providers for the buildings will actually provide them with the construction. And so the capital needs are pretty minimal up front. And so free cash flow should more than cover any expansion and also be able to sort of continue paying that interest expense. As mentioned, the valuation is very low. Here's a few financial highlights. As I mentioned, the top line growth. They're finally EBITDA and free cash flow positive. And the inflection point here just sort of illustrates, I didn't show previous quarters, but sort of illustrates the growth that you're seeing over the last 2 quarters in terms of revenues and adjusted EBITDA, which makes me think that the guidance for this year, although Q3 is a bit seasonal, could prove conservative, and the company could definitely exceed those EBITDA targets. A quick glance at this peer table indicates that Cansortium is, as I mentioned, one of the fastest growing and cheapest cannabis stocks. I'm happy to share this in further detail once I'm finished. And in terms of valuation, as I mentioned, valuing the Florida operations on next year's EBITDA at about 6.5 times, which is still below the industry, below all of their peers, ones that are growing slower and with lower margins. That would result in a significantly higher share price than 20 cents today. And those estimates, as I mentioned, just include Florida operations alone and exclude any incremental EBITDA from Pennsylvania. and potential license value for Pennsylvania or Texas if they decide to try to monetize those for capital. One thing I haven't gotten into in too much detail is that Texas is an incredibly restrictive state, one of the most in the country, if not the most. And Consortium is one of only 3 license holders in the entire state. Obviously, if favorable regulation were to pass, Texas would be an enormous market for both medical and adult use. And a company like Consortium would significantly benefit from that, but also could monetize their license over time should they decide not to expand in the state. And I would estimate, based on industry conversations and research, that the value of that license is probably worth in excess of the entire market cap, taken with a grain of salt, but providing some downside protection. And any changes to regulation would obviously provide a huge tailwind to the entire industry, Consortium as well, by allowing capital to come into the space, lowering interest expense, getting rid of the burdensome tax regulations, and sort of allowing and increasing adult use in the state of Florida. Lastly, the company would serve as a pretty strong acquisition target for a larger operator or a strategic trying to either enter into Florida or expand their geographic presence. Consortium is 1 or 2 dispensaries behind the number 3 or 4 largest operator. I'm sorry, the number 5 largest operator, and maybe 8 or 10 behind the number 3 or 4 largest operators. And so at their current scale, run rate, everything, I think it would be very accretive to a larger operator. And then here's some catalysts, and happy to share this with anybody who's interested or take any questions as well.
Okay, thanks, Adam. I don't believe we have any questions. No, I don't believe we have any questions. So thanks for your participation in the event.
Sure. Yeah, thanks a lot. Appreciate it.
Okay, our next presenter is Matt Joas. Thanks for being here, Matt.
Hey, thanks for having me. Can you hear me okay?
I can. Sound great.
Very good.
What time is it over there?
It's just gone 6 a.m. So I think my 2-year-olds are just woken up. If you hear any screaming, I don't have hostages. It's just how they like to wake up.
Well, we're warned, but yeah, the floor is yours.
Yeah, excellent. Let me just share screen. Cool. Is that coming through okay?
Yeah, looks great.
Yeah, so my name's Matt Joss, Chief Investment Officer at Maven Funds. I'll try and keep the intro part brief so we can get stuck into the stock that we're going to talk about. Originally from New Zealand, grew up very interested in investing from an early age, but didn't really have like a framework to hang it on until I discovered Buffett, like a lot of people in my early 20s. Kind of took over my life then. At the time, I was living in Copenhagen, Denmark. Joined a grad program for a big shipping company. Very clear kind of career path ahead, but investing kind of took over my nights and weekends during a long, cold Danish winter, and realized it was time to kind of make it a full-time career. Around that time, I also discovered Motley Fool and their style of growth investing. And that kind of sets the stage for, I guess, the approach that we take at Maven, and my preferred approach is this merger between these two ideas of value and growth and high optionality growth investing. I know David's presented at this conference before, big influence for me. And another gentleman, Joe Mager, who's presented here before. I moved down to Australia, left that safe career to join the Motley Fool and work on a portfolio service with Joe called Motley Fool Pro. Just focused on Australia and New Zealand small cap companies that have we thought had the ability to grow to be very large. We were fortunate enough to identify a few businesses that went on to become kind of darlings in the market, tech businesses like Xero, WiseTech, Altium, etc. And then I left there a little over 2 years ago, kind of thinking I'd manage my own money, do something just with friends and family. But we had a lot of those former clients reach out. People had some good returns, and it was just, I guess, quite motivating to me. A lot of folks who were able to give back to their communities. One gentleman wanted to start a charity with some of the other investors. Someone else was building houses in developing countries. And yeah, I guess it was a big motivator for me, is kind of helping people with investing. So that's what led to the launch of Maven just over 2 years ago. So Maven, why the name Maven? a big part of our focus, I've heard at a few presentations I tuned into today, is finding what we'd call a fundamental inflection point. But basically a business whose fundamental cash flows are going to be radically different in the future than they have been in the past. Can be a few different reasons for that. The one we'll talk about today is when there's a segment of the business that's grown much faster than the existing business. So over time, it's kind of hidden to begin with, but over time, as it rises, it dominates the whole business. And the name Maven comes from the book The Tipping Point by Malcolm Gladwell, where he described these certain people who are able to identify trends early. They're kind of like a trusted expert, watches everything that's going on, and then communicates what they see to other people at that tipping point. That's what we're trying to do. Our approach, we call it finding monsters, but it's essentially trying to identify companies we think have the ability or potential to become multi-baggers, but aren't, I guess, not just getting there being lucky. So there's, in Australia in particular, there's a lot of speculative mining companies. Literally half of the index by number of companies would be those. We're not trying to find those. We're trying to find businesses we think have something that you can value and something that's repeatable. I'll come on that again in a second. Our motto comes from Thomas Phelps' book, 100 to 1 in the Stock Market, where he says that to be successful in the market, you must have the vision to see, the courage to buy, and the patience to hold, which I quite liked. So again, our approach, like a lot of folks, are trying to find these few businesses. Thomas Phelps' book talked about a few traits they all have. We call them monsters, kind of an homage to Monster Beverage, which was well over a 2,000-fold return. So 10 grand becomes over 20 million, even more than that today. And what we like again about it is that it's something that you could have foreseen at the time. It's very easy to look back at a biotech or something that's really speculative, and I don't think I could have predicted that, but we're trying to build a process around it. So part of the traits that he found in that book, that study from the 1970s of businesses that had these big outcomes, start out small, they have a unique edge, superior management, and they're misunderstood at the beginning, which helps with multiples. And just to tie it together, I guess the style that a lot of us are talking about has become more popular over the last few years. If I think back to 2021, it felt like everyone was looking for these big growth companies, but I think a lot of people had made the mistake of a bull market and quote unquote learned to ignore valuation. And I guess our approach is we're always trying to bring it back to valuation. I think the kind of oversight with traditional value investing is thinking of it as a static exercise. So I like the analogy of a tree. Like imagine we've got a 6-foot tall tree standing here. The kind of traditional approach would look at that and say, there's not that much timber on the tree. What could we make, like a baseball bat out of it or something? It's not worth that much. But if you look at that business or that tree as a living organism, we think businesses are more like living organisms in a dynamic environment, then you should be thinking about the future. And that's what we're trying to do. It's trying to understand the kind of ecosystem, the complex adaptive environment that the business operates in, and then identify those that have a much brighter future ahead and bringing it back to valuation and tie it together. So without further ado, let me jump into the company we're going to talk through today. Very Australian company, I thought fitting for our focus is Australia and New Zealand. Australian listed, tickers MAD, Mader Group, a bit under 400 million USD equivalent market cap. I think it's an underfollowed compounder. It's been compounding at over 30% a year for a long time since its inception. It's replicating a proven business model innovation. It's got very high insider ownership, including the founder who owns over half the company. We think at least 33% upside to fair value based on our estimates. And as I'll get to, I think that it could even beat that. And some big global tailwinds. I'm sure a few others are presenting at this conference about what's going on in energy and mining, that there is this potential for a shortage. There's really just a crucial shortage of labor in this market, and that's what Mader provides, which we'll get to in a sec. So again, before I get into the business, it ticks a lot of the boxes. These are kind of like our ideal list, and typically a very good opportunity will hold some of these. It's very rare to find something which has all of them. I won't go through all of them right now, but just to, the highlights: very aligned, competent leaders, high returns on incremental invested capital, strong unit economics, demand and supply side competitive advantages, misunderstood, we'll get to that in a sec, tipping past a fundamental inflection point, the high growth new verticals, and most importantly is undervalued. And I should just say, first mover in an emerging and important industry. That comes directly from David Gardner, one of his 6 traits that he looks for. And I believe that at least with this business model that Mader's pursuing, they're a first mover. So what does Mader do? maybe go back to the beginning. It was only 17 years ago that it was launched in 2005. Luke Mader, the founder, was working in the Pilbara, which, if you don't know Western Australia, it's hot, dusty, very dry, very remote. Nobody's around. He's sitting out there, probably leaning up against one of these huge tires, twice as big as a man. He was working as a mechanic, working on this equipment. So he was working for one of the, what we call the OEMs, the original equipment manufacturers. Think like Caterpillar, who make this big, heavy mining equipment. And he was one of the service people. So for these mining companies, they make most of their money selling the equipment. And then they make a lot of money, very high margin money, on the spare parts. But the services part, they had really been neglecting. Because it was the default option for a lot of people, they didn't think about it, they just went to that provider. It meant that they took it for granted, essentially. And what he saw, he was working for them, and he basically saw they had a very sweet gig. They charged a lot to clients. They're very slow to respond. They were difficult to work with. They'd never work on any equipment that wasn't their own, and didn't pay their workers that well, even though these are very highly skilled workers. It'd be very common for a diesel mechanic in the Pilbara to be earning $200,000 a year. And it's the recipe right for disruption, as he saw it. So that was Luke's opportunity to enter the market and disrupt what was going on. So what Mader provides is a workforce of mechanics. Started out with diesel mechanics. It sounds kind of boring. Again, we'll get into why I think it's so interesting. These are really critical pieces of machinery. If a machine's offline for a few days, it could be hundreds of millions or billions of dollars of revenue, depending on how long it's down, that is lost. So it's really critical that they have high uptime. And this is a kind of mission critical service that they're providing. It's also tied to production, not exploration. So it's quite different, as we'll get to other mining services businesses. This is what the virtuous cycle I think Mader's been on. He started out, Luke, just himself recruiting some of his mates. They recruited their mates, and they focused on just getting the best mechanics that they could find. Because of that, they developed a reputation for quality, and they were able to win more mine sites. With that, they're also able to launch new verticals, like we'll touch on in a minute, get higher margins. And this is a really key point of their model: increase utilization. Traditionally in this industry, it's common to have 70 to 80% utilization of labor. Mader works on 95 to 100, and they're disappointed if it's below 97. So really high utilization. And that means more flexibility for those workers and higher staff take-home pay, even if the hourly rate's a bit lower, basically because they're working more, so they get more at the end of each fortnightly cycle. That all makes it a great place to work. Mader's won numerous awards for being a great place to work. And that's really a key for the linchpin in all this is recruiting top talent. One of the things that Mader does differently is moves people around a lot. That flexibility, the more sites you're on, means that you can move people around. These guys hate getting stuck at some boring, dusty mine site with nothing to do. They want to move around. They want to see a bit more of the world. And that's Mader now, with particularly international opportunities. The US and Canada can do that. So that basically Mader is a business model innovation. We talk a lot about tech disruption. Mader is a business model disruption. They're disrupting the original equipment manufacturers on this side, who are way overcharging, offering a better service. Mader's cheaper and faster. And then on this other side, kind of the small operators that Mader grew out of, they might try and undercut Mader on price, but they're just not able to be as reliable, as we'll hear in a minute. If someone calls Mader to get a job done, they know that they can get a mechanic on site very quickly, get a high quality service, and it's got a really strong culture underpinning that. So Mader today, from 17 years ago, it's now run rating at just under 500 million in revenue. These are all Aussie dollars. It's got over 2,200 staff. Just over the last 5 years, it's been CAGR revenue at 30%. It's even higher. Before then, they're guiding for another 23% plus year of growth revenue. It's very early in the year. It's the financial year here ends in June next year, and Mader has a history of upgrading and beating its guidance. So I think they've got a good shot at doing that, a very good shot at doing that this year as well, if everything continues. Aligned and competent management. So Luke Mader, the founder and still an executive director, is very crucial to growth in the business, owns over half the company. Another director owns about 19%. So insiders together have over 75% of shares. And the CEO, Justin Newich, is a very competent CEO. Luke brought in a professional CEO to manage the scale as it grew to be a very large business, but he's very incentivized to grow net profits with targets around FY24, 40 million and 60 million in 26. And we think that's quite achievable. If there's two words to sum up the Mader thesis, I think it'd be the scaled repetition. If you think of the best businesses or the best compounders over time, typically what they're doing is they're finding a formula that works, and then they're scaling that up to larger and larger markets. So Coca-Cola, right? They found a secret magical formula that you can drink as much of as you want and you never get sick of it. Then they found a distribution formula that worked. That two together, they scaled that globally, state by state and globally. Same with Walmart. They find a shop model that works. They scale it out. Starbucks, there's a Starbucks in your Starbucks. I think that this scaled repetition is the key to a lot of this compounding and finding monsters. And what's interesting about Mader is they're scaling into larger markets because they started in Australia, where they're now very dominant. They're about 10 times bigger than the nearest competitor, but they're now scaling into North America, Canada, energy. They've got another international segment as well. These markets they're growing faster there, so over 100% revenue growth in North America. They're also a lot higher margin. So North American EBIT margins are almost double Australia's, around 18% versus say 9 to 10% in Australia. And in this chart, they're just outlining that they've replicated this model in many different markets around Australia and then now internationally. Mader talks about its growth drivers. So I think that we just highlight that there's a lot of different verticals that they're now expanding this model into. They're trying to repeat this into. And we just put a green box around these top ones. North America, again, growing 100% there off a decent revenue base now. Mader Energy is very new. It's just been launched. Mader Canada just been launched this last year. It had no real meaningful contribution to last year's numbers, but it seems like intense demand. Management have talked about it being the strongest vortex they've ever seen. And then infrastructure maintenance, that's going out to all their existing customers, think BHP, Rio, and recognizing it's not just the mobile, the big Tonka trucks that you guys drive around that we can work on. There's also all the fixed infrastructure that you have, which covers a whole lot of different processing, machinery and transport, etc. And that's a different recruiting base, which is key because Mader, like a lot of this industry, is constrained by talent. So going into infrastructure maintenance, let's go out and target a new area to recruit. The bottom line is we think each of these top ones here have the ability to be larger than the current businesses today, some of them significantly larger. Then you've got other secondary growth drivers expanding into rail, ancillary, power and marine. We really think if Mader is able to maintain its culture, that it has a really good shot of entering these different markets. So a lot of what I talked about today, you could probably read from just digging into the business itself. So I thought I'd give a few nuggets from some of our deeper research. We talked to competitors, customers, former employees. This was when we asked someone what their thoughts were on the competitive landscape. This is a competitor to Mader. They said, I don't think it's a comparison to be fair. Mader are in a league of their own. They're far, far above. They've got a huge reach. With money, they have the ability to have marketing departments, so they're advertising everywhere. And another quote, I think everyone knows that Mader is the go-to because they're always able to get people out onto your site. And this is another competitor who's one of those smaller competitors trying to compete, talking about how Mader, that this competitor can pay those employees more. But if they were purely taking the money, they could go work for these smaller contractors. One of the things about being a mechanic is that you can't really stay in one place for too long. And that's one of the biggest issues. Guys don't like to work for the big miners. You're stuck in one mine site. You're stuck with the same supervisor. If you don't get along, you're in trouble. Unfortunately, it's too bad. Whereas being a contractor with Mader, you have the ability from one day to the next to go to a different mine site. And now they have the ability to recruit internationally to Canada. A lot of their employees are young guys, very talented, and they want to move around. They also send some folks over to Africa and train people up. It's a very dynamic business. So we think it's got some important moats. That trusted quality reputation is really key. That's what the business has been founded on, and it's important that that is maintained. A really strong culture. Cultural moats are very fuzzy, but I think they're incredibly powerful, and they don't fit in a spreadsheet, so they're so easy to overlook. I think of something like Chick-fil-A as my quintessential cultural moat. Like, why is that business so successful? It's not even open one day of the week, but it's because of that intense culture. That's what we think is developing at Mader. And we think it's a really strong thing that ties the business together, makes the best people want to work for them. I think scale and utilization, as that kind of virtuous circle turns, they get more and more scale. That means they can respond to jobs faster. It means that they can utilize the staff more, because if there's ever any idle time, if you're a small shop, you have an idle guy, what do? They always have somewhere that they can send workers to. And they are able to invest and have better systems, admin, billing, recruitment. That sounds kind of like obvious, but no other competitor that we've found has scaled past around 150 employees. And I think it might be something to Dunbar's number of how many relationships you can manage, but basically the systems start getting really complex when you manage that many people. And you have to run this business really efficiently, and that's something that Mader does well. So what we think the market's getting wrong, kind of the same bias that we had when I first looked at the company. It's like mining services, who cares? These are typically really capital intensive businesses, very cyclical and very levered to exploration or construction phase, which if you think that you're about to have that can be a great trade, right? If you think we're about to have a lot of that boom. But for a multi-year potential multi-bagger, that isn't that attractive. What's different about Mader? So for one, it's tied to production, not exploration and not investment. That means basically it benefits if there is a mining or energy boom from more production coming online, but then it stays at that level because it's tied to the maintenance and repair of equipment, not to the build out. We looked back at how 11 different publicly listed mining services companies in Australia handled the mining bust in 2014 to 16. It was really brutal. 4 of them went bankrupt, 7 that survived the downturn, their revenue fell by 15%, and the rest swung to a net loss, 300% decline in net profit. But over that same period, Mader was able to keep growing revenue and keep generating profits. So we think it's a really good past test of the business. And just looking forward, we can see that it has modest capital requirements and really high returns on incremental invested capital. And it's growing to be more diversified. So it's becoming less risky as it grows. Very quickly, some of the risks that we think about, China slowing down, about 40% of the current business is tied to iron ore. Some things offsetting that though, the customers that they have are the lowest cost curve producers. So BHP, Rio, etc. They're way down, they're making vast profits today. So the price would have to fall a heck of a lot before it really hurt them. And even if it did, those businesses tend to continue to produce tons. So we'd expect to see a lot of Mader's business there be kept around, but also it can be redeployed. The biggest constraint in this business is labor, trying to get people onto site. And lastly, just culture. So very quickly, catalysts. We think there's explosive growth in Mader Canada, Mader Energy in North America, and fixed infrastructure, potential for a re-rate and earnings growth at the same time. We're estimating intrinsic value to be over $4, about a 33% upside, but more importantly, because of its low multiple, we think it has the potential to keep compounding at sort of 30% a year. Comparable to another business here in a different industry, similar margins that trades on almost double the multiple. Yeah, so that's all I have time. I don't know if we have time for questions, but feel free to hit me up. I love collaborating with folks on this and talk to a few investors about this idea as well.
And Matt, just maybe a couple questions. I was curious on the customer side, was there one big customer that sort of adopted them first, that kind of got them started? Was it Rio or one of the bigger ones? That kind of thing.
Yeah, that's a good question. There was a couple of early, I think I kind of started off with some of the smaller guys and worked their way up. But no, it wasn't, they haven't had hyper customer dependence, and they've thankfully scaled out of that. So yeah, no, it's just, they started off as one of those small guys that they now compete with, and just through, getting past that hurdle of around 150 employees, they've kind of crossed that chasm.
Are they somebody from a mining company that has multiple mine sites, or is Mader sort of the primary service provider across all of the mines, or is it mine by mine? Do you have any idea what that looks like?
Yeah, it's kind of both, I guess, depending on the arrangement. They have these master agreements with some of the big guys, and then they'll do, that's about half their business, and then kind of floating. And again, this is just for the repair work. There's still other service companies and labor hire companies they'd use, but yeah, often they will be one and kind of then scaled out for everyone. They sign this master agreement and then used everywhere. But some other sites, when they're newer, like in North America, it might be more site by site.
When they entered North America or got into other areas like oil and gas, was that done just strictly them starting at zero, or did they make an acquisition?
Yeah, they looked at an acquisition. I had to cut a quote out of this. The CEO had a great story looking at an acquisition in energy, and they looked at it. They had 70 to 80% utilization of this business. And they looked at that and they said, basically, if you have a culture that's okay with that kind of low utilization, it's going to be so hard for us to change that culture. We might as well start from scratch. The CEO is also incentivized around net profit, not just growing EBIT. So there's an exclusion clause for acquisitions. the end result is they've grown those from scratch. North America was a really hard graft. The founder went over there and started again. That shows he's still hungry. And the other two have just been launched in the last year. And again, from Greenfield. I think culture is really key here. And so that's why they so far at least have gone that way. They have mentioned though, if they got into defense or something else, they might need to acquire to bring that skill set in.
Okay. We had one question come in as well. Why is CapEx PP&E so high for a staffing business?
So they buy trucks. I think the core thing is to look at this versus other mining services businesses. And the PP&E, the most recent year is really high because they've just built out in advance for North America. So they have like a few guys to a service truck. That actually comes down over time, and we think it gets to 25 to 30% returns on incremental invested capital. So we're very okay with that. They're also mechanics, so we would guess that they probably stretch the useful life of those trucks a lot longer than you might expect looking at the accounting treatment. So yeah, that's basically why. That's all the CapEx is, just buying a service truck so they can drive out to these remote locations and be there quickly.
Okay. Okay. Well, thank you, Matt. I appreciate the presentation. Thank you.
Excellent. Thanks very much.
Okay. So our last presenter of the day is Josh Young. Josh, are you there?
Hey, yeah, I'm here. Looks like my microphone or my thing. 1 second.
Yeah, no problem.
Not sure. I think this might be related to my webcam. I'm sorry to delay this slightly.
No problem.
And re-plug back in. Yeah, it's coming. It's pulling the audio or the video. I'll just do a low quality video directly from the computer.
Okay.
This
Looks good. Yeah.
Okay. Great. Okay. Here I'm gonna screen share. Let's see if I get this directly in here. Slideshow. Great. Okay. Cool. Can you see the presentation?
Yeah. Looks great.
Great. Okay. Cool. Okay, so I'm Josh Young with Bison Interests. Thanks for having me. I'm going to go through a brief background of who I am, who Bison is, and then walk through a microcap idea. Let's see if I can get this. Okay, important disclaimer. Give that a second. And I guess just this isn't an offer for the fund or a recommendation of any specific security and your own due diligence. So we're going to go through again overview on Bison, talk about our investment philosophy and sort of how we figure out what to focus on and what to buy. Brief on oil and gas because the idea is an oil and gas company and the specific idea. So a little bit about me. I've been doing public equity investing for a while, focused on oil and gas public equities for the last decade or so, which is why I look a lot older than in that picture. And I was chairman of the board of a public company in the oil and gas space and sold it profitably at a time where not a lot of oil and gas company stocks were doing well. There have been a few stocks that I've talked about publicly over the last couple of years that have done pretty well. Talked about these on TV or sort of very public formats, and this is important because we have to get our registration changed for our fund, but can't sort of disclose performance. And I think it's important to sort of calibrate idea performance in terms of understanding quality of research as well as understanding sort of, I guess, the likelihood of a future hit rate. So far, stuff that we've shared publicly has done pretty well relative to the index of publicly traded oil and gas companies. So what we do is try to find, there's a number of oil and gas publicly traded companies. I think it's sort of in a 300 to 400 range now across North America and other jurisdictions, upstream, downstream, midstream. And we look for companies that are undervalued with decent assets that are cash flow generative, great management teams, and where there's some catalyst line that can help unlock the value. And then it's very important that the assets are able to support balance sheets under a variety of circumstances. Oil and gas is obviously extremely volatile, and this idea we're going to talk about in a second has survived sort of the worst oil and gas downturn maybe in history with negative prices. I think it's important to the extent that one invests in this space to invest in companies that are survivable and where the people are there sort of adding value every day. One of the things that we do that's pretty different from how a lot of people approach the space, in addition to sort of having an older school sort of valuation heavy focus, we're also looking at idiosyncrasies in the oil and gas value chain that aren't well understood. So with the prolonged downturn, there was sort of an evisceration of the let's say sell side experts and outside experts, as well as the buy side ability and sort of bench to evaluate the space. And so things that might seem either very esoteric or very obvious can often lead to very interesting public equity ideas that are able to outperform. I'll give a couple of examples, well, 3 examples. So you could tell in late 2020 that there were 3 different things changing, that in West Texas, natural gas prices had been heavily discounted, that in North Oklahoma, natural gas and natural gas liquids prices had been heavily discounted, and that in Western Canada, and this was in a little later, it was in early 2021, that heavy oil in Canada was heavily discounted. It was possible through understanding that those situations, which had been the case for a number of years, had changed. It was possible to identify individual securities with exposure to those specific things that also met our other criteria, that were able to do materially better than the average oil and gas company. And again, that's very relevant because in a sector that is as cyclical and as poorly understood, it really helps to have these sorts of factors that are very underappreciated, misunderstood. And it is a benefit from having focused on a space that's been hated and mostly left for dead for a very long time, is being able to come in and sort of pick this sort of special situation, this sort of extra catalyst that allows material outperformance versus sort of the average oil and gas company. And I think in all of these cases, the companies were microcaps at the time of the start for this chart. So it's helpful. Also, I mean, at this point, I don't think any of them are. And so obviously that helps to have multiple % sort of returns on ideas to get them from small cap or micro cap up sort of that larger cap range. Very briefly on oil and gas, there's a lot that people say about it. There's a lot of different things people are tracking. There is a big thing that's not on this chart, which is just that China right now is actually locked down for COVID, and a presumption that would make it relevant to invest in anything in oil and gas would be a presumption that China would eventually sort of reopen. That's, I think, baseline. Frankly, investing in almost anything related will also be tied to that, along with many other different sectors. Oil and gas specific, outside of that sort of global macro question, inventories are still drawing kind of amazingly, even with China locked down. Amounts are very low relative to the price of oil. Oil and gas equities are a very small percentage of the overall market relative to what they've over time, particularly where they've been at prices that are anywhere close to where they are now on an inflation adjusted basis. And then there's just not a lot of capital spend still relative to how much has been spent historically globally across upstream and oil field services. And so you kind of need a lot more spend for a number of years in order to get back into an adequate supplied market. So there's going to be a lot of demand driven swings, but over time, and there is that significant step up in spend, it's likely that oil will stay high. And again, you can just look through the history of oil and gas. You really need this top right chart, the global E&P spending. You need to see that spending up higher than it was in 2014 on an inflation adjusted basis. And get there for at least a few years, potentially more, in order to get back into an adequately supplied market. So Journey Energy, I own the stock. And again, please do your own due diligence. It's producing a little over 14,000 barrels a day. Market cap is just over 300 million Canadian. It's got pro forma about 100 million of debt, or it should exit at that end of this year, assuming roughly $80 to $85 oil, which is right around price and the forward curve through the end of this year. And so just really quickly, it's a very cheap stock. It has good asset economics. It's doing a roll-up, which is really interesting, and we'll get into more on that later. The CEO is great and has made people a lot of money before, and they have some hidden assets that offer significant downside protection, along with an ability to essentially unlock material value over time. So we've talked about Journey before, and it's done really well, and it's done very, very well relative to its peers. And one of the things that I think is interesting in the stock market is people hate stocks that have gone up a lot, and they hate stocks that have gone down a lot. And often, and I guess they also hate stocks that are just flat and have done, and often the things that we'll find that are most interesting have one of those sort of three share price patterns. And so in this case, I think people look at the company and say, hey, well, the stock's up a lot, therefore I've missed the opportunity, when in fact, the valuation is very low, they're executing on an excellent plan, and they're on track to potentially earn a very attractive return, even relative to how they've done so far. So one of the interesting things about it, again, in the context of the stock gone up as much as it did, is their run rating like close to 2 cash flow. They have enormous free cash flow, and they traded a large discount to the third-party assessed value of their producing reserves, excluding value for inventory and undeveloped and the less likely reserves, the probable and possible in the reserve category. So it's pretty rare to find companies that are doing very well and are this heavily discounted. And my thesis is just people look at, you see the stock went up a lot, and I think they have trouble getting over that in order to buy it. And again, there isn't some sort of story on, hey, there's some product that's going to sell really well and then, may or may not continue to have traction. They're selling oil, and the oil macro assessment is doable and sort of independent of Journey's individual prospects. What they're doing is pretty simple. They're just taking assets that have a very low decline rate, and they're cash flowing them. They're reinvesting full amounts in order to grow slightly organically. And then they're taking the rest of the cash flow, paying off and buying assets at accretive prices and just doing it over and over and over again. And that's very sort of boring from a management perspective. And it's not sort of the hot thing to do with resources stocks, which is to pay dividends or buy back stock, but it is a mechanism for generating well above industry average returns over the medium term, even through sort of multiple movements in both directions in commodity prices. So they have a lot of upside from current oil and gas prices, and pick your price. This is just, we pulled it from their corporate presentation. They're estimating that
let's give him a few minutes or a few seconds to see if he comes back.
$140 million next year in free capital. That's again relative to their pro forma debt they're getting. If they were to do that over a, let's say, 3-year period, they could pay off all their debt and buy back all their stock. And then, they could do that all over again, or pay sort of very, very high dividends supported by their free cash flow. So very, very cheap. I thought this was interesting. A friend pulled this together. Fact-checked most of this is sort of directionally consistent. I wouldn't rely on individual transaction metric from this, but basically Journey has been buying assets over the last 18 months. And when you look at the valuations of their assets, just on a very sort of simplistic high-level basis, they're paying on the low end of the going rate for assets at the times that they're buying. And as they do that, to the extent that they continue to be careful about the assets that they're buying. And again, this is just on one metric. I think they actually look better on other metrics. So this is price per barrel of oil produced per day. The other metrics that I think make them look even better is they're buying production that has very low decline rates. So their reinvestment requirement is very low. And so I think that really helps in terms of the ability to generate a lot of free cash flow from it. But as you buy cheap assets and you just keep doing it over and over again, as long as you're buying them for a big discount relative to where your stock is trading, you're going to end up generating a lot of accretion. Excuse me. So the last aspect of this is that they have this power generation that they've been ramping up. And here, sorry, 1 second. That they have the power generation they've been ramping up. Power in Alberta is scarce because they've been shutting down coal power plants. There's a wide spark spread. Journey is vertically integrating the power generation with their natural gas assets. They're rapidly growing power generation, and integrated power generators could arguably be worth, let's say, 10 times EBITDA versus their overall business trading at like 2 or 2 and change EBITDA. So with that, I'm going to open it up for questions if there's time for it, and maybe to be able to drink a little more water.
Thanks, Josh. Thanks for the presentation. I guess maybe what question that I have as a kind of a newbie to oil and gas investing is, what would you say are the biggest 1 or 2 mistakes that new investors in oil and gas make, when they're trying to figure out like where to invest in individual equities?
Yeah, so I think the thing I see that people do most is they find an individual stock that they think is interesting and they focus on that particular company rather than doing a scan to find other similar companies to see if there might be companies that are cheaper or at the same valuation or slightly more expensive, but a lot better. And so I think it's really risky to come into a space, find something that sounds good, and then potentially end up paying on the higher end of the valuation range and getting into sort of a lower quality opportunity from one of a variety of different metrics.
Okay, and you're presenting on GOI. I'm curious, in your portfolio today, like how do you kind of rank this company versus the other ones you're in? Because you're probably in some larger caps as well, or maybe not all micros. I'm curious, like how do you rate kind of this one compared to the rest that are in the portfolio today?
So this is actually my largest position. I bought more of this. The sector is very cyclical, and that's probably an understatement. And so this stock in the last 2 years, it's gone from, I think, under $1 to 7 something, back to 4 to 7 to wherever it's at 5 something. So it pulled back a lot recently, and I bought a lot more of it. And then I added after they announced their most recent acquisition, which was really transformative. It was very impressive. Bought an asset for like a little over $20,000 per barrel of oil per day. So this is actually right now my largest position. I do own shares of companies that are larger. I have some exposure to companies that are actually a little smaller than this. And I think it's less about, I think people get hung up a lot on size. And there was another presentation earlier that I thought was great. Actually, I think a few presenters talked about this. There are amazing opportunities for small funds and individual investors on the smaller side of the market. Like there are attributes of Journey that people love with larger companies where they're paying twice the valuation, but like, let's say the stock is more liquid, or, it's a $3 billion market cap instead of the 300 million or something like that. And I think it's just a huge mistake for retail investors or small fund managers to focus in an area that's sort of better understood where valuations are higher instead of focusing off the beaten path where there's really potential to generate an excess return.
And we had a question come in. You cut out for about 15 seconds when you were going over the valuation slide. Would you mind going back, kind of going over that again?
Yeah, no problem. Sorry about that. So was it this slide, the transformation that they're seeing, or was this?
I thought it was this slide here.
Is it here? Okay.
Yeah.
Yeah, sorry. It's funny. You test the internet connection ahead of time and everything's great, and then it's a Murphy's Law. It's guaranteed to cut out. So the company is generating substantial free cash flow. So this is their forecast for operating cash flow. I believe they show this net of interest costs, and so this is just over. This shows their free cash flow at, let's say, around 40% of their enterprise value. And it looks like their use of proceeds, I mean, realistically, the use of proceeds is hopefully to go buy another asset at an even cheaper valuation. But at a cheap valuation like they just did, to the extent that they don't find something as compelling, their use of this free cash is to just, I mean, they'll probably spend around $40 million to grow organically and to increase their power generation, and then the rest of it to pay off essentially all of their debt next year and have some extra money to either grow more or to build a cash balance or maybe to start paying a dividend or buy back stock.
Okay, thanks for going over that again. Wait, one last question. Does Journey have assets in Clearwater area?
Journey does not. So I've talked a lot about another company that I own some stock in that has, it was very interesting, again, on the small cap and micro cap area in terms of just really talking up. I can't emphasize it enough that people who aren't constrained by having enormous assets under management, I think, should focus on smaller companies. There was this whole trend in Canada towards Clearwater oil and gas producers, and people were focused in one area. And there was this other company that I actually owned a little stock in where they put out these great results and people just like wouldn't even look at. I think partly because it was a small stock and partly because they had a troubled past and a whole stock was unrelated to Clearwater. And there was this great opportunity last year to buy that stock at like 6x since then, but like it's up 6x since then on well results. You see at the time when the stock was close to $1 and now it's over 6. And so similar thing, I think, with Journey, less driven by specific well results. I thought of showing their well economics. They're very, very good. They're not as good as the best wells in the Clearwater, but they're more than good enough. They're sitting on 15 years of inventory. My thought is the thing that really distinguishes Journey is just their ultra low corporate decline rate. They're really having to reinvest a tiny amount of the money they generate, their ability to pay off huge amounts of debt very fast. And then even in a very inflationary environment, like I showed for the oil macro, there's very few oil rigs running relative to the price of oil, and that's changing, and services costs are rising rapidly. Low decline producers like Journey are extremely well positioned. So another presenter talked about a services company, which should do quite well in oil and gas. And the other way to sort of play that trend is to own low decline producers that have very little capital intensity and are able to generate a lot of free cash flow under a variety of circumstances. So that's the argument for focus on this rather than companies that have sexy well results.
And maybe just more of a portfolio question. How many positions do you own in the portfolio?
I have about 25. So it's my ideal sort of portfolio construction would be something like a few companies that are roughly 15% position cost, and a number of companies that are much smaller, that are sort of more asymmetric, but where there's more risk of permanent capital impairment. That would be sort of a 2 to 5% position. That those would be in there. And then the reality is that these things sort of sometimes end up with larger or smaller percentages based on where opportunities pop up, and things aren't smooth, especially on the smaller side of the market.
And so in an industry like oil and gas, obviously you have a long-term thesis towards oil doing well. How do you, I'm curious how you manage the portfolio, something like Journey getting bigger and bigger, going up like it has, like, do you kind of sell the pops a little bit, or how do you manage that at the portfolio level?
Oh man, that's a great question. I think that's the best question I've been asked in a while. It's tough. I think there is a reality to this sort of thing where when you look at the best performing fund managers in the world with their sort of like longest track records, some of the best ones, especially the equity focused ones, they hold these sorts of positions and they don't sell them. And, people talk a lot about compounders, and I think it's really, really hard to hold positions like this because they can end up dominating your portfolio. I have had to trim a little bit of this on rips, like when it went over, I think it was over $7 briefly earlier this year. I did sell a portion of the position, and then it's fortunate that I did that because I was able to back, I think I bought back around the entirety of that, plus I might have a little bit more in that pullback. So I'm not really trading oriented, but when something performs like this, it becomes necessary from a portfolio manager perspective to trade a little bit. But there really is this, I like a lot, and I like the people that are running it, and they've done this before at this scale, and have taken a company that had this sort of performance looking back. They took it to a multi-billion-dollar size twice. And so this is their third one. The CEO is independently wealthy, and he owns millions of dollars of stock that he bought personally at around the current share price. So it's pretty. I think this is a sort of thing where I lean on my risk controls and I try to hold a larger position for longer.
Thank you. Now, thanks for sharing your thoughts on that. Something I've been meaning to ask you. So, and thanks for joining us and sharing us more about Journey, during this afternoon session. It's really appreciated.
Thank you for having me.
Yeah. Well, Josh was our last presenter of the day, and we have a happy hour, a social that's coming up at 6 p.m. Eastern. So if you have an hour, and then hopefully you can join us back for that virtual social that we'll be having at 6 p.m. Eastern. Thanks for tuning in today, and we have a busy day again tomorrow. It's going to be an amazing day of 12 microcap companies presenting. They're all very, very interesting. And so if you can't make it out to the virtual social later today, we'll see you bright and early tomorrow, I believe at 8:20 a.m. Eastern. So we'll see you then. Take care.